webcasting is working. That is great news, step one. And as a result, I want to officially call the meeting to order. And I would ask that we have roll call.
Governor Michelle Lujan.
Here.
Peter Frank.
I'm here.
Secretary Padilla Jackson. Here. Linda Eidson.
Here.
Tim Jennings.
You can go.
Harold Lavender.
Here.
Treasurer Eichenberg.
Present.
Commissioner Garcia Richard. Here. Scott Smart.
Here.
Lee Rawson.
Present.
Lynn Hoffman. Lynn, are you on the phone with us?
Yes, here, thank you.
Thank you.
All right. We have a quorum, and thank everyone for participating in the meeting. Let's go to introductions. So folks who are viewing can be reacquainted with folks who are here at every meeting, and folks who are new based on the agenda get introduced. So I'm going to start. Let's start with Senator Tim Jennings. Come around the table this way, and then go around the wall.
Okay, I'm still Tim Jennings. Never appointed by the Senate.
Good morning, Senator.
Good morning.
I'm good.
Me too.
No, you're cut off from coughing. No caffeine on this side of the table.
I just sent you a text.
I've been working today.
That's a good one. I'm sorry, Governor, I wasn't paying attention to which way you pointed the finger. I'm next. I'm Tim Eichenberg on the section. She always starts with challenge. That's the best way to start your day.
Scott Smart.
Hello, everyone. I'm Stephanie Garcia Richard, State Land Commissioner.
I'm Harold Lavender, recently confirmed for my next term, public member.
Lee Rawson.
Linda Eidson. Olivia Padilla Jackson, GFA.
Governor Lujan Grisham.
Peter Frank. Steve Moise. Ben Smith.
Good morning, everyone.
Rich Earl Pullman.
Marcia Beard, the RDK.
Matthias Bauer with RBK.
Carrie Siegel, SIC staff.
David Lee. Chris Cassidy. Stephen Hoffmeister, admin.
Bob Weaver with admin.
Richard Pugmire, Pavilion Alternatives Group.
Alan Waldrop with Pavilion Alternatives Group.
Mark Barnhill, Platinum Equity.
John Bailey.
Dan Pritchard, Renewable House.
Jennifer Powers, Global Infrastructure Partners.
Martin Stuckey, SIC staff.
Jennifer Wildman, Axia.
Timothy Ness, Taxi. Justin Green. Dino Carpenter.
Starla Bennett, SOC staff.
Clay Camper, SIC staff.
Eric Tyson.
Kenneth Segura Knowles, Invest in Mexico.
Well, welcome, everyone. I'm going to actually ask, it's very loud. That's very nice of you. I don't know why we always do that. We have trouble for all of our meetings remembering to close the door. And I think that we've got the temperature controlled so that will work and we can minimize noise and traffic back and forth. All the coffee's at the end of the hall. So there's plenty of movement. All right, so the next item of business on the agenda is actually to approve this agenda, which was provided to each of us in advance of the meeting.
So moved.
All right, do I have a second? We have a second. Do I have any discussion about the agenda? Seeing none, I would ask us to vote. All those in favor of approving the agenda, say aye.
Aye.
Any opposed? Any abstaining? The motion carries. Current agenda is approved. The next item is the approval of the minutes of the February 26, 2019 meeting. Do I have a motion to approve?
Second.
So I've got Secretary Padilla Jackson and Senator Rawson, is that right?
Sure.
Leave second, okay, wonderful. Do I have any discussion, additions, changes to the minutes? Seeing none, all those in favor?
Aye.
Any opposed? Any abstain? The motion carries. The minutes are now approved. All right, now we're on item 2, which is State Investment Officer and Chief Investment Officer briefings. I would ask Steve Moise and Vince Smith to walk us through their reports.
Thank you, Governor. Good morning, everybody. Total distributions to the state in the past 12 months have totaled $951 million. The price of oil yesterday, West Texas Intermediate, $59.08. And our value of assets as of this morning, net asset value of $24 $449 million. If you would please take a look at the SIO report page in your materials, page 15. I'll talk in just a moment about the tax stabilization reserve bill that passed the legislature and is sitting on the governor's desk. I'd like you to look, if you would, at the dashboard, which is page 16, and just specifically at the two boxes in the lower left-hand corner. The price of oil as well as production, as requested by the land commissioner. The commissioner asked us to show the orange line on each of those bar charts, which explains the relationship between oil and gas pricing and production. I think that was a good addition. It's a little bit hard to read because it's so small, and if any of you would like a larger version of it, we'd be happy to get that to you. In the upper left-hand corner, I just would direct your attention to the bottom comment. In fiscal year 18, approximately 14.3% of the general fund budget came from the permanent funds, and that number obviously will change. And then over in the top right-hand corner, the blue box showing contributions and distributions from the land grant and severance tax funds. Just focus, if you will, on the bottom line, the total lines of contributions and distributions, and I think that tells a story that all of you are well aware of. Moving on, legislation. Charlie is going to comment on several of the bills in just a moment.
Yes,
I'm sorry to interrupt.
Sure.
When you were talking about the fiscal year 18 appropriation being 14.3%, you said, and that will change. I'm trying to understand, I can understand it might change to fiscal year 19.
Correct. It will change for FY19.
Okay, I just wanted to make sure that was,
that we weren't changing right now, that there was something.
well, 18 should be close to done.
Correct.
Okay.
There's nothing that will change for 18.
Thank you, Senator. I'm sorry I didn't see you. Go
Thank you.
ahead, proceed.
You bet. We'll give you details on bills other than tax stabilization return in just a few minutes. Representative Tomas Salazar carried this bill, which was endorsed by the council, House Bill 393. We're told by LFC that we should expect an initial balance of approximately $650 million in the tax stabilization reserve as of July 1. It could be more. It's a great year to begin investing in this fund. And New Mexico can now say, we have a rainy day fund. We couldn't say that before, but now we can. We will invest these funds as you, the council, and as the treasurer recommend to us. Staff will make a recommendation to you, and Vince will be commenting on that in just a few minutes. There will not be a vote taken today. If we invest that $650 million and earn an additional 2% over what could be earned in the short-term markets, we could earn $13 million or more for the state in the first year. And that fund will grow because the earnings will revert to the fund rather than passing through to the general fund as a result of the bill.
And to the tax stabilization.
To the tax stabilization reserve. Inflows generated from other than the oil and gas school tax, which is what provides funding to the stabilization reserve, come from Senate Bill 401, which is the federal mineral lease revenue source, and that could provide another $45 million a year to the reserve fund. Oil and gas matters. Obviously, our funds benefit from non-renewable resources, not from the renewables. Oil and gas production increased 42% between 2017 and 2018. Natural gas increased 13%. Major years for those two metrics. Land grant permanent fund royalty inflows from the state land office in February of 18, $54.8 million, as opposed to that same month. Pardon me. Let me start over on that. February 19, $68.6 million from the state land office in royalty inflows to the land grant permanent fund, as opposed to the number $54.8 million the year before. So 54.8 growing to 68.6. Severance tax collections in FY19 projected at $551 million. All these numbers are important for us to know as a council in order to have some perspective about how our funds can grow and can benefit the state. In the February meeting, we were asked to provide detail on the New Mexico Private Equity Program. Pavilion will be reporting on this under their report today. You have that in your materials. The governor asked us to comment on liquidity of our funds as well as market trends, and Vince will be commenting on that here in just a minute. We'd like to keep you informed about what we're doing, speaking around the state. We have two upcoming speaking engagements, one in Albuquerque and one in Santa Fe in May. And we are preparing an insert for our 60th anniversary report, updating it with the new members of our council and revised data so that those numbers are as current as they can be. We're not going to print a new one. We're going to just insert a page, and I think that's the most efficient and economical way to do this. In terms of staffing, we have an offer pending for a public equity analyst. We've had good response to our sourcing here recently. Another offer pending for an investment strategist, and perhaps more than one. And we are also looking for a new communications analyst since Jody left us. We have a change in the time of the audit committee meeting. Next month, it'll be moving from 10 o'clock to 10:30. Other than that, Governor, I think that's all I have.
Do you have any questions? Christie? Yes.
Just one note, I noticed that maybe it was in the Wall Street or somewhere, but there was an article in there about the Saudis were doing what they can to increase the price of oil to $70 and reduce it. So I don't know, it'd be nice if they did.
Okay.
I mean, it's, if they can get there, but it's just a lot of oil. Reduce their production, increase the price to $70 a barrel.
Any reactions to that? I didn't see that, but there's been plenty of news about their investment strategies, their oil and gas production, the current price, and I guess more than anything, the new Crown Prince, but or new-ish. I don't know if there's a reaction to that potential strategy and impact on global oil and gas prices or the market.
Governor, I think the consensus revenue group was using $56 as their estimate.
That's their
Is
estimate.
that true? Yeah.
We're at 59. Let me ask a question. I
Yes,
heard on
Peter?
the news this morning that there's road construction down south. Is that true, Lee and Governor? That will improve our ability to get the oil and gas out of the basin?
So, Vice Chair, it is in fact true that in the capital projects or the capital bill passed by the legislature and on our desk has considerable resources for particularly Highway 285, which is a main route to get the oil and gas, the trucks, and it's a problem. And we were also hoping that there's gonna be local investments that, I think it might be a little, not quite a match, but not a requirement of that appropriation, it's not contingent upon that. But rather, it looks to me like we're building a relationship or a set of relationships so that we can finish whole phases. So the amount of money that's been appropriated by the legislature, combined with local direct investments, could get us complete funding of phase one. And I can't remember what the complete funding of phase one is. 285, 200, it's almost a matching. But for both phases, I can't hear you.
Oh, I said over the 2 fiscal years, it was, Governor, about $400 million. But I'm not sure about the phasing.
Okay, so we should get that to the group, but yes, in fact, there's considerable amount of money that's identified and considerable strategies to make sure that we're doing two things. That we don't minimize the economic activity in that region, which would minimize our economic opportunities on this council, but also there are considerable, frankly, public safety issues related to that particular highway. So both are addressed.
Madam Chair?
Yeah.
So just in addition to that, the building of more infrastructure in terms of pipe to transport product, I think is really sort of all hands on deck, ensuring that that's prioritized, ensuring that we're doing everything we can from the state agency side to encourage the build out of that infrastructure for this type of capacity issue.
And there's efforts underway, both in terms of what's already been appropriated and what would need to be appropriated, both from the state and for infrastructure building and private sector investments for additional pipeline infrastructures in both San Juan County and in Lee and Eddy County. Yep, Senator?
There's a group of people in south, you go anywhere between Roswell and Carlsbad, somewhere in there. Artesia has probably one of the best sites because they have one of those 100-car train stations that they could put in a plant that would take natural gas and make polyethylene pellets out of it, and they make polyethylene pipe there. There's a real chance here it's pretty close to pipelines. If they do the Artesia one, it's real close to pipelines, and they have a 100-car train terminal there, and they can put in a plant to make up to 16-inch polyethylene pipe, which is a big deal for transportation of the pipe. There's one guy down there that's 300 miles of pipeline to put in, but if they could do that, it could give us a market for our natural gas, which could help us a lot if we can get some little help from the state, put some pressure on put that plant somewhere down there. And I brought some plans on it where they show the facilities that they can add with the cracking plant or refinery, whatever. They come in and separate the molecules out and make those little beads, and then they can sell the beads off. It could be as much as 100 cars a day. The polyethylene stuff that they would ship to California.
Any other questions, comments, or statements? And I think what we can provide to the members, we can do it from our office, and we'll do it through SIC council staff, is once we go through our capital outlay bill and finish our review of bills and sign, we'll make sure that folks know what those investments look like and where they are and what the potential gaps could be without having completely all the infrastructure, which we would never get done right everywhere that we need it, particularly here, but showing the advancements that we're making and what the gaps are, so that members have that information for future meetings. And we'll make sure we get that to you. All right, any other questions or comments? Okay, thank you. Vince?
Thank you, Governor. Well, I've just got a few comments, mostly on the economy and a little bit to address the governor's questions from last month, and then we'll flip over to RBK to talk just briefly about the performance numbers. You've seen January so far. We're getting pretty close on February, but just not quite the time for the meeting. But I'll have a few comments about the January report. And then I'll be back and talk just briefly about the TSR potential asset allocations there. So at your place, you have a packet that starts out looking like this. It's the most up-to-date information you can get, except for this front page. It's just a little bit out of date, but that's okay because it makes it helps you make a point. All these two charts here, just focus on the top chart and focus on that orange line, right? That orange line is the yield on the 10-year treasury minus the yield on the 3-month treasury bill. Now, normally, long-term rates are substantially higher than short-term rates. Today, by this chart, they're just about zero. Today, they're actually negative. So the yield on the 10-year treasury is lower than the yield on the 3-year treasury bill. Now, that's been all over the news, so everyone knows that. What I want to talk a little bit about is the implications. So the first implication is if you look at either of these charts, every time that orange line dips below zero, in other words, every time the yield on the 10-year is above the yield on the 3-month bill, we go into recession. You get one of those vertical gray bars that indicates recession. Not every time, but most of the time since the 1950s, when that inversion happens, the inverted yield curve happens, we're pretty close to going into a recession. So that's sort of the situation that exists now. If you flip the page, let's look a little bit deeper because this is more important than just simply the ratio going below zero. There's three ways that number can go below zero. You can have stable 10-year rates and have 3-month rates rise and exceed those rates. That's probably the best way, if there is the best way to get to an inverted curve. That's generally indicative that the economy is fairly strong. So 10-year rates stable, 3-month rates are coming up and exceed it. That's happened a couple of times in the past on those dips that you saw on the first page. That's probably the best way to get there. The other end, the other way is, the second way is the opposite, where 3-year rates are stable and the 10-year falls. That's probably the worst way to get there. That's indicative of a slowing or a weak economy. And we'll look at that here in a minute. Of course, third way is both of them happening at the same time. 10-year being stable but coming down a little bit, and 3-month coming up. The reason this is the toughest way to get to an inverted yield curve is simply because when the economy gets a little bit weaker, shorter term investors rush toward treasuries and push down the yield on treasuries. And that's what's happened here. So if you look back in November, toward the end of October, early November there, 10-year rates were, this is the bottom chart, were about as high as they got, about 325 or so. That first big decline is, oh my gosh, the stock market's falling apart. So that's what was happening then. So stocks fell about 20% from their peak in September down to their low on Christmas Eve Day, which is where they bought it. The stock market's recovered, however, but interest rates didn't. So you can see interest rates going sideways there in January, February, into early March. This last down leg is, oh my gosh, the economy's falling apart. Now, it's not a bad observation. If you flip to page 2 of this, that's actually the last one. This is a colorful chart, sort of a heat map of global economic momentum. So you can see we weakened up a little bit there in 2015, 2016. We talked about that several times in this room. Yeah, then comes 2017, we start strengthening up on the back of the tax cuts. So those started delaying in 2018, and here we are early 2019. If you look at that last column, it's all red, except for Peru, which is a really tiny economy. It's not all that helpful that Peru is growing. It's helpful for them, but in terms of global economy, it doesn't mean a lot. The big economies, though, you can see there at the top, the G10, the US, Euro area, Germany, UK, all of those are really losing economic momentum right now. The indicators are really starting to roll over. We'll likely print a positive number for this quarter for annualized GDP, but it'll be 0 point something likely for annualized GDP for the first quarter. So we're narrowly going to stay out of recession here in the first quarter, at least the first quarter of a 2-quarter recession. But only by the skin of our teeth, I think, will stay above 0. So really start to lose economic momentum. That's what's causing, I think, the downdraft we're you've seen in the 10-year treasury here lately, that's what's causing the erosion of the yield curve, is fears about global growth. Southern Europe's in recession, Japan's very close to recession. All of Europe will narrowly escape recession this year, it looks like. We're very close in the first quarter here. We'll bounce back in the second quarter. GDP was our expectation, but the first quarter is looking pretty close. Even here in the US, where economics are not the strongest in the world. That middle page that's in there, if you take a look at it, this is probably the issue I'm a little bit concerned about. Part of the reason the economy is slowing is because the Fed raised interest rates, and that top chart is the graph of what the Fed's done. So Jim Gillen pops them up there in 2015, and then that's about all we can do. And then we go off to the raise this year, starting right off the beginning in 2017, and it rates up about 2.5. Now the thing about Fed fund rate increases or decreases, but the thing about Fed fund increases is they don't really start impacting the economy until about 9 months after it happens. So if Fed raised rates tomorrow, that rate increase really wouldn't feed into the economy for another 9, maybe even up to 18 months. So the two vertical bars that you see on the pins during that time frame is 1.875. We're at 250. So there's another 67.5 basis points of Fed increase yet to hit the economy, and you've already seen the economic momentum slowing. So Janet Yellen, the former Fed chair, who, for whatever reason, I found myself agreeing with her more often than I did with Bernanke and Greenspan before him, but she's calling for rate cuts, and it's probably not that bad of an idea. We're at 250. The average 9 to 18 months ago was 1.875. At least heading in that direction would take some of the rate cuts not quite in the economy yet back out. So we'll see what the Fed does on that. The bottom chart is sort of the stock market. You can see we've been going sideways since we peaked in 2017 there. A lot of that's been due to the Fed increasing interest rates and tightening monetary conditions. The stock market really should not be this dependent upon interest rates. So we're keeping our eye on it. Things are really starting to slow. We still have more monetary tightening coming into the system via the previous Fed funds interest rate increases, plus the balance sheet. PayPal is still selling securities, or at least not reinvesting the proceeds of things that come due. He says that's going to stop in October. We'll see in October this year. But it's a little bit dicey right now in terms of where the economy's going to go. Our main forecast is still the mid-2020 is the most probable time of a recession, but that could be coming forward if something doesn't happen on the monetary front. The stock market, of course, as we've talked about in the past, will send that out 6 months early and start rolling.
Right, you got a question, Peter?
I didn't quite follow your comment, that the stock market should not be that dependent on interest rates.
So Peter, we had this 20% fall off here that you can see on that middle page, from September down to Christmas Eve there. That was really in response to the Fed raising interest rates. The market really is feeding on low interest rates right now and easy monetary policy. And as soon as we started tightening, it threw a 20% fit. So we'll see if we can get monetary policy at least a little bit easier. As we talked about last time, it takes about 500 basis points in cuts when you get into a recession to have a stimulative effect. We've got half of that. And the stock market's not accepting even that. Well, the governor did ask about liquidity last time. We've been selling into this. We've got 250 billion for April 1st, and I think we had an additional 250 on March 1st. So we've been rebalancing back as the stock markets come back here. So that's created a good bit of liquidity for us. We're also holding a little bit more than 1% on each land and Severance's balance sheets, and all of the private pools, the 4 private pools that we have, we don't have them loaded up with cash. So in the short run, we've got plenty of liquidity in the short run to make sure we make the distribution. We've got, of course, the 10% sitting in the core bonds portfolio. If this market really starts falling apart and we need to rebalance, those shares can be easily sold, likely at a profit, to put that in the stock market as we really get another big downdraft.
Any questions, comments for Vince? All right. Thank you.
So over to RDK for some performance.
And this will be very brief, it's a January flash, and then if you go to page 19 of the book, then so it shows you at the top right-hand side, looking at the target allocations and where you stand, and really no different here, you're underweight, your non-core fixed income and Bart is working to build that up. So working on getting you closer to that, to the target. If you look at the bottom of the page, you can see performance for January. Your return for the month of January was 3.92. You did see some slight underperformance against the policy index. If you turn to page, let's just go to page 21, and you can see the performance for each of the composites. Again, the land grant was at 3.89, slightly trailing the policy index. And if you look down at the composites, you can see some slight underperformance for U.S. equity, but the biggest contributor to underperformance for the month was in the fixed income and non-core fixed income in particular. This is a benchmarking issue that some of the holdings in the non-core are lagged a month, and the benchmarks weren't, so we're working with staff to true up and how to report this. Over the long run, it evens out that you can't have these dramatic periods as you had in January where you're gonna be away from your benchmark. So that's something we're working on, so that's where most of the underperformance you can see came from. It's non-core fixed income. And February's performance isn't in, but we're showing, what we're seeing is preliminary numbers are, looking better than some of your peers have been able to calculate performance, so, positive performance in February, obviously.
Okay. Any questions or comments? Yes, Mr. Treasurer?
Marcia, I know you told me this once before, but why do we keep doing that TAA stuff? Because it just seems to be a drag on every one of the charts that you've got in here. Why are you doing that?
Page 23.
Well, it's 23, 24.
Okay.
Each one of them just seems to have a kind of drag to it.
Yeah, the TAA, which really here is tactical asset allocation. It's a bit of a misnomer here because really what it means is deviations from your targeted policy benchmark. A lot of that is really frictional, not intentional, but a byproduct of just managing the portfolio. Obviously, transitioning assets isn't immediate and it's not costless, so there are going to be deviations from the benchmark. And yeah, sometimes they work against you, other times they work for you, but they're really not intentional. In this way, the way that the name might imply through tactical. So again, I think it's more a byproduct of just managing the portfolio, and that being a process that takes time.
And Mr. Treasurer, you'll notice that it gets a little bit larger when the stock market's really rising quickly, and that's us moving money from stocks to our private investments to meet those targets. So we don't actively manage, we do actively manage the allocation relative to the benchmark through the policy guidance, but we don't take active bets. We don't say we want to be 200 basis points overweight stocks in a period.
Any other questions or comments? Okay, thank you very much, Marcia. Anything else? Back to you, Vince or Steve?
Okay, thanks, Governor. If you flip to page 41, there's just a brief memo in there from me. We wanted to show you some of the early work that RDK had done on potential asset allocations for the tax stabilization reserve. You see three allocations there. The first one just has the first three asset classes in it, no real estate. Early on in some of the discussions, there was some concern that the real estate might not have enough liquidity for this fund. I think we assuaged those fears, but we did want to show a mix without real estate since that was an early concern. We didn't hear anything about it in later committee meetings. I think we've taken care of that. The other two are just sort of a middle mix, and then a mix that has a little bit higher expected rate of return, a little bit higher risk. There is a number I left off of there. At the meeting put on a have it, but I should. And that number's 13%, and 13% is roughly the expected volatility of the permanent funds. So you can compare that to the last line in this report and see that we're taking roughly, a third of the risk that the permanent funds take in terms of their investments. So quite a sound, at least low volatility solution for the TSR. So just want to put those in front of you, kind of give you an idea of where we're going. Obviously, we're doing some more work this month, and we'll be back to you next month with a recommendation. I would suggest it will look a little bit like number 3.
Any questions or comments? Yes, Mr. Treasurer? Yep,
You gotta keep educating me here again. On the non-core fixed income, what's in that bucket?
So that's, there's a lot of floating rate debt in there, Mr. Treasurer. It's mainly credit exposure, so not a lot of interest rate risk, but mostly credit exposure. So let me back up, I'm glad you asked that. So the low duration fixed income is a rough proxy for the short-term markets. We've got a little bit of credit in there, we have a short-term high yield portfolio in there for some of that allocation. But that's a rough proxy for what the short-term markets can do. The core fixed income just adds some interest rate risk, some term risk in there to try to pick up a little yield. So we can move out the yield curve in normal times and pick up more yield. We can't these days, but so that's just a little bit of interest rate risk to pick up some return. The non-core fixed income is primarily take some credit risk to pick up some premium for that. And then real estate just picks up some general economic risk and non-corporate risk. So it's a little bit of a diversifier, but allows us a premium there over the short-term markets. So that's those three things are primarily we're attacking it kind of from three angles in terms of investment taking or investment risk taking to pick up the premium that we think we have over the short-term markets, which as Steve said is about 2%.
Yes, Scott? Okay, we defer to Stephanie. Commissioner?
So, you mentioned, Vince, the, comparative risk from the permanent funds. What's the comparative on these others, the expected returns?
We're expecting around 7%.
So lower risk,
For
lower
the land
return both for the.
Right. So as you go out the risk curve, it's fairly flat right now. So you have to take a lot of extra risk to get a little extra return. So we can only pick up, about 2.5 percentage points over that with permanent funds for, 3 times the risk, 3 times the volatility. That's just the way it is in today's markets.
I was surprised, I've often thought real estate in relation to fixed income was almost always more risky. But that center column, when you introduce real estate, that allocation number 2 carries slightly less risk than the first one that has no real estate. What's causing that?
The diversification fact, it's the fact that real estate just does not, it's not highly correlated with corporate risk. So that's the main reason for having that in there is we can pick up some yield premium on something besides corporate risk. There's a little bit of interest rate risk in the real estate portfolio, but not near what there is in the core fixed income.
But is that going to be sort of a selective group of real estate that's much less risky than, say, I don't know, an apartment complex in Timbuktu or something like that?
It's units of the real estate pool, which present is about 55% core and 45% non-core real estate. So it's units of that pool.
In that type of real estate, you can sell it on a 24 hours notice?
No, liquidity comes from 2 places. First, it's all funds, which are diversified across property type. So the first line of liquidity there is just simply the cash flow that flows that comes off of those investments every month. And the size of the investment that we'll have there is pretty small. I mean, it's 20% of $600 million right now. So relative to the total size of the real estate portfolio we have, the cash flow that comes out of those funds on a monthly basis to cover it. If we got in a tough spot where risk assets are selling off and other investors in those funds are sort of lining up for the exits, that's the time that land grant and severance tax will be looking for risk assets like that. And it's likely need to buy the units that the tax stabilization reserve would have for sale.
What would happen if we had to theoretically take this tax stabilization reserve and you had to bring it down to 0? And you had that 17% real estate, is there a risk that if we had to liquidate that, we would suffer a loss?
We
Under
don't,
a certain set of circumstances, or is there a way to avoid that?
we could see price loss. That's the volatility works up and down. So we could see price loss. You know, if we were down in a real bad risk market, we could see some price loss, but we get the money out.
Because when the state was dealing with the Great Recession, or whatever the heck it was called back in 2008, 09, and we started scraping dollars from every corner, I think we ended up having to come up with about $1 billion in cash to keep things moving at the state level. So if we ever did that again, I would hate to see us in a position where we're forced to make a large drawdown like that and had an asset that we had to liquidate that we lost X percent on.
There was, we'll include it in when we do the write-up for next month, but Harvey K produced a chart that showed what happens to the fund if you just get the roughly the rate of return on cash markets, and if you get this extra 2%. And after a 10-year period, even if we had a 3 standard deviation, more than 3 standard deviation drawdown, well, about 3 standard deviation drawdown, you still have more money at the end of the day. So while you might lose some off of your present NAV, it doesn't take very long before you outrun the cash market far enough.
Okay, thank you for that.
Any other questions or comments? All right, seeing none, back to you unless that's the end of your briefing.
That's it, Benjamin.
Okay. Thank you very much. All right, we are now on item number 3. These are investment matters that require a vote. A is the first before the vote's an investment committee report, so we're gonna go to Linda.
Okay, I'm gonna make this just a little bit longer than usual because many of you are new and don't know what the investment committee does. So I'm gonna give you an overview about how we look at these investments when they're presented to us. The committee looks at these investments and then votes on whether we wish to recommend them or voting at the SIC. These are the types of things that we're looking at so that you know how well we have looked at these before they even come to you. And of course, this is after the incredible job done by our consultants and our state investment office staff on analyzing, sourcing, due diligence, when it comes to us. We look to see if the proposed investment meets the allocation target for the asset class. So in other words, real estate, real assets. Does this meet our asset allocation requirement? We're actually be under the amount that we are targeting in most of those classes because it's very hard in these private asset classes to suddenly go from 7% to 12%. It takes time, and we have to have a pacing schedule. So most of these are going to meet that requirement. Then we want to see if it meets the sub-asset class allocation. So, for example, in let's say private equity, we'll have so much in buyout, so much in venture capital, so much in opportunistic. Does it meet those requirements in those sub-asset classes? Another will be, does it have manager diversification? We have a policy that says that you don't want more than 35% with one manager. Many of our managers are what we call re-ups. We already have a relationship with that manager because we don't want to have hundreds of fund managers that are different companies. We want to deal with the biggest and the best in class, and we will deal with them on subsequent funds. Oftentimes we call them re-ups. If a fund that we invested in previously is now maturing and paying out, and we now got a new fund that does the same thing, that's a re-up. So we will oftentimes be working with managers with whom we know, but we want to make sure we don't have all of our assets in one or two managers. So we want to make sure we have manager diversification. We want to make sure that it meets the best practice for fund sourcing. In other words, why did the consultants and the state investment office staff pick this fund? Did they look at other fund managers? What does this fund have that is unique, that is compelling over other funds? Why did they pick this one? Then we want to make sure that thorough due diligence has been done on the fund, and this is done by our consultant as well as our state investment office asset class director. We want to make sure that terms of the fund are within the local guidelines. This has to do with the fund
document itself? Are the fees within a reasonable amount? Is the carry within a reasonable amount? Do we have protection on key persons? Do we have clawbacks on carry? All of these things, what are the terms and are they within the guidelines of best practices? Then we want to see if it meets the annual policy pacing. It's very important for us to have investments in each year, because if you just dump the money in 1 year, try to get up to your target amount, that may not be the year that's really good with that particular fund class. And two of the things that are very, very important for how a private asset class performs is the vintage year, the year in which it starts investing. And I guess maybe not surprisingly, it's the years when the market's really awful, that they can go in and buy bargains. And we don't want to miss those really good years. So we want to pace that we have investments each year. So does it meet the pacing? The other thing that's really important on the success of any fund is its manager. And so it's very important when they bring us the fund, why they pick that fund, why they pick that manager, and why this is a top manager, and why that the people in that fund are going to stay there. So we're going through all of this. Another is just what makes this fund attractive for the SIC? How does it complement the other funds that we already have? And another that they always bring to us is what are the concerns that they have with this particular fund? Not every fund is perfect in every way. There'll be some little flaw that they say, well, this is a concern to us, but they'll tell us what the mitigating factors are. So when we as the investment committee are looking at these funds that are brought to us, these are the things that we are looking at. We are not looking to say, shall we invest in this? What we're looking to say is, are you following the process that we have established to examine these funds and make sure that they are right and that we can recommend them for the SIC. So that's what's already happened at the investment committee level. And many of the questions that you ask here were asked at the committee level also because they're excellent questions. But we take more time than even you do here to go over those investments. As far as the March report, we had the fund performance report, which you have seen here. We noticed the short-term slight underperformance to the benchmark, but we had it explained that that's largely due to a benchmarking issue on the non-core. We were slightly out of our target deviation on the amount that we have in non-core and core fixed income, and we're explaining that we're trying to get more and more into non-core, which is a relatively new asset class, and we've had quite a few presented to us for those fund investments. We have an overview of several factors that are going to influence the annual plan, which will come in June. The information that Vince gave us today is the type of information that will go into preparing that annual plan, which tells us what the allocations will be, what kinds of investments, and is a very, very important document for we as the SIC to establish. We had an excellent presentation by our consultant Townsend on their analysis of the U.S. and global real estate markets and the current and near term, and how this is going to influence our annual report. What type of real estate are we going to be looking for? What type of funds are going to be introduced? So as we look at our annual plan, we will have a pretty darn good idea about what type of funds are going to be brought to us over the next year. We also looked at each of the investments that he brought to us today, and we approved those unanimously. We had presentations by both the consultants and the State Investments Office staff. We had discussion about them all, and over the things that I discussed, we look at with each investment, and we did unanimously approve all of them for recommendation here. Advent is a new manager to us, so this was somebody who we were most anxious to look at more thoroughly. Platinum is what we call a re-up, meaning we have a fund very much like it that's maturing, and this is just another one in that series. And the Global Infrastructure Partners Spectrum Fund, Global Infrastructure Partners, we have other funds with them, but we don't have any funds in this series. So we know the manager is just a new series to us. So when we look at these managers, that kind of gives you an idea about what goes on at an investment committee meeting.
Thank you very much, Linda. Are there any questions or comments regarding Linda's presentation or about the investment committee? All right. Are you sure, Senator? It looks to me like you're thinking about one. You're good? All right. Thank you very much for your presentation. So then we will go to those items requiring a action vote. So we are on the Advent International, and we've got our presenters making their way. Good morning, gentlemen.
Good morning.
Proceed.
Good morning, David Brady, Private Equity Director. We're here today to talk about Advent Global Private Equity Fund 9. Advent has a control-oriented global buyout strategy. We expect Fund 9 to have 30 to 35 investments, and check size will range from 100 million to over $1 billion. Advent concentrates on 5 core sectors: retail, consumer leisure, business and financial services, industrials, healthcare, and technology, media, and telecom. The Fund 9 will have a $16 billion target and a $20 billion hard cap. And for perspective, Fund 8 was $13 billion, Fund 7 was $10 billion. Historically, 54% of these investments have been in Europe, 40% in North America, and 6% in Asia and Latin America. The general partner commitment here will be at least $500 million. Advent, the organization, was founded in 1984 by Peter Brook, who was also founder of TA Associates, who we brought last month. And it's been operating across multiple continents since 1989. Staff considers their large global footprint and network to be a strong competitive advantage for this firm. For perspective on that global footprint, Advent has 391 employees, of which 158 are investment professionals. They're working in now 15 offices in 12 different countries. 154 of the 198 investment professionals are dedicated to the global private equity series that we would potentially invest in. Of the 198 investment professionals that I just cited, that includes 21 in-house employees of the portfolio support group, but it does not include 97 third-party operating partners, 26 operating advisors, and more than 150 industry advisors. So Advent overall has about 36,000 companies in its database, but it utilizes its sourcing cells to focus on the 1,000 pearls, which are the most highly attractive. And recently, Advent added Brian Taylor, who is a veteran of TPG, to help augment their technology expertise. And they're raising a companion fund right now with a target of $2 billion that will invest solely in technology companies. This fund has no preferred returns, so similar to a couple of other funds we have, TA and Hellman, but there is a 130% net asset value test before carry. Relative performance has been consistently strong. Funds 5, 6, and 7 are first quartile on a net multiple basis, and first and second quartile on a net IRR basis compared to the Burgess Global Buyout Universe. Distributions to paid-in capital is also first quartile for funds 5 and 6, and second quartile for fund 7. On a nominal performance basis, for the last 4 funds, funds 5 to 8, the public market equivalent return, or PME return, is 23%, and that's versus 11% for the S&P 500. When Advent underwrites their company investments, one thing I wanted to note, they have a minimum target return, but they also look at the breakout potential for an investment. managers would say that they do that, but I just wanted to give you a couple of statistics on how well they do. 27% of their invested capital from funds 5 to 7 is marked at above a 3.0 times gross multiple, and 10 out of 80 investments are valued at above a 5.0 cost. And you should keep in mind that this is all with a historical loss ratio of 6%. So not taking outsized risks here. So in conclusion, I would note, as Linda also did, that this would be our first commitment to Advent funds, and staff and consultants are recommending a commitment of up to 100 million. And with that, I'll turn it over to Trish from America.
Great, thanks, Dave. Yeah, Advent is a new relationship for you, and if you recall from our performance report, we have a target of 30 relationships long-term. We've done 24 relationships since 2011, so we have a high bar for new relationships when we're evaluating managers that are coming in. And I also wanted to talk a little bit about the process. You usually see the final recommendation, but you don't see the work that comes beforehand. We have regular meetings where we talk through a forward calendar, which has a list of the re-up funds that are in your portfolio, and then also new opportunities. And we talked with Vince and David and Chris on a regular basis through these funds. And over a year ago, we started talking about Advent along with some other funds, had them meet these funds. Advent rose to the top. Advent's a group that is considered hard to access for new investors. We had a previous relationship with them, but David and Chris did an excellent job of really talking about the State Investment Council in the state of New Mexico and getting Advent excited to have you added as a limited partner. And we expect you're going to be one of the few new limited partners if approved to this fund. David did a great job talking about some of the merits. I'm just going to hit on some of the risks from our recommendation and then turn the time over to Advent. So one of the things that we looked at was the larger fund size, and this is a common theme from strong performing groups where you do see the fund size increase over time. And the things we look for is how they performed in the past as they've grown the fund size. And Advent has been able to continue to perform strongly as their fund size has increased. They've also increased their team and their capacity to manage new investments as they've grown. And then we also took a look at how they did with large investments versus small investments. I mean, their 2008 and 2012 funds, the large investments actually outperformed the small investments, which gives us confidence that as they grow the fund and make larger investments that they're going to perform well. Similar to what we see with firms that have a long history, there is some transition right now as senior members of the team retire, but there has been a gradual transition, so it's not an abrupt change to the organization, which we like to see. And then David mentioned one of the things about the terms. The fund does not have a preferred return, which is common for what we see with some of the strong performing funds out there. With no preferred return, the risk is that the manager could potentially pay themselves carried interest sooner than they otherwise would if there was a preferred return. The nice thing about Advent's terms is they do have that NAV test. So if the fund is performing poorly and they have a realization, they're not going to pay themselves carried interest unless it's performing at a certain level. So that's a nice protection for investors in place of the preferred return. And so with that, I wanted to introduce Stephen Hoffmeister, who's a managing director in the Boston office. He's been with Advent since 2004. And Bob Weaver, who's a managing director and global co-head of LP Services, and he's been with Advent since 2015. And they're going to give us a short presentation, and we're happy to answer any questions.
Thank you very much.
Good morning, gentlemen.
Good morning. It's a privilege to be here. Thank you, Governor. And everyone in the room. You said an awful lot, and I'm going to do my very best to ad-lib and not repeat what you said, but I think maybe the most important thing is to just to let you know it really is our privilege to be here. Yes, we're in the very happy position of having more capital wanting to come into the fund than we're going to raise, but it's also, I think, incumbent on us to always introduce new investors to our funds, and we're delighted to do that with you should we be approved. We are raising $16 billion for the fund. One of the things and one of the tenets of our organization is that we have always, over the last 4 funds, increased our deal professional headcount at a rate greater than the amount of money we're raising. And the point there is we like to be able to turn over more stones, see more deals, say no more often, and then hopefully, if we're doing our job well, find those diamonds in the rough. So we don't view the business of private equity as being a scalable business, i.e. raising bigger funds with the same number of people and having fall more to the bottom line. What we'd like to try to do is think that we're seeing more opportunities and being increasingly selective, which in this marketplace today with high valuations is really, really important. Just a couple of comments on our partnership. Advent is an increasingly unusual organization in as much as we are owned by the 45 partners in the business. We don't have outside capital, we don't have a public stock, we haven't sold to a secondary firm, we aren't public, and we don't intend to do any of those things, and which makes it a nice place to work. We don't have a CEO. Of the 45 partners of the organization, we have 15 people that are managing partners, and that group collectively governs the organization and makes strategic decisions for the organization. And nothing important in Advent happens without a consensus agreement. And it's a very unusual place in that respect, and again, one that's quite rewarding. Just a comment on evolution and transition of senior people. These gentlemen said exactly correctly that every time we raise a new fund, we do have some people that move on, they retire. When the senior people at Advent leave, it's generally to go fishing or go teaching or whatever it is that kind of post-professional life holds for them.
Is that what it is, fishing?
Yeah.
For me, it will be.
Good to know.
It's a few things, but it generally isn't going to a competitor. In fact, it never is going to a competitor. People tend to join Advent and stay at Advent for the life of their careers. Not without exception, but that's certainly the rule. So I will pause. Stephen Hoffmeister is one of our senior deal makers, and I thought it would make sense for Stephen to talk a little bit about our investment process, where we do it, and how we do it.
So I appreciate that everybody on the council has read the slides, so I'm not going to go through any of them in particular, but I will try to bring to life a little bit of how we work. So at the core of what we do on your behalf, potentially, is to generate attractive absolute returns through sustainable business transformations. What does that mean and how do we do it? It starts with finding the best opportunities with the most transformation potential, which we do proactively inside of specialist sector teams that David referenced. We then work with our management teams to execute on growth plans. We're a growth-minded investor. These are multi-year growth plans. When we get to the end of successful implementation of those plans, we typically sell our businesses or take them public. And there's a bit of discussion earlier about when the economy is good versus not good, and when it makes sense to sell. You would see, looking at our data, we've been really disciplined about selling when our plans are completed and not being slow, not trying to take that last dollar for our investors. We find it better, frankly, to be disciplined about selling when we get to the end of a plan that we've underwritten. Let's talk a bit about how we find our deals. We have these 5 global sector teams. They're really global in nature. Each of them is roughly 40 people, 40 investment professionals. Inside of those teams, we are trying to generate the best possible deal opportunities and do so on a really proactive basis. We're not waiting by the phone, hoping that Goldman Sachs will call with the next great deal. We are out in our markets, in our geographies, trying to find our next great investment and try to find that transformation potential. We do that with the support of terrific operating partners. We have about 100 of them. These are people who have run companies that we hire in the sectors that we spend all of our time in. And then we have dedicated team resources against those sectors. Even within that, it's a little bit more complicated. We have chosen subsectors within our sectors. So think about business and financial services. Within that, we are probably the preeminent investor in the payments space, credit card payments, debit card payments. That's an area where for a long period of time, over a decade, we've been dedicated, sustained investors in that space with resources both inside of Advent and also outside, doing 8 deals, investing almost $3.5 billion and generating really good returns for our investors. So think global and sustained focus on specific areas where we really have And then that really describes how we find our investments in terms of how we build them. Keep in mind that it's about growth, and the way that we generate that growth is multifold, but what really sort of binds our strategy as you think about what we do well is we have a really talented team. David mentioned some of the numbers before. We have one of the largest teams in private equity, both in terms of just absolute number of individuals and also in terms of people per $1 billion. We have a lot of resources to help our companies grow. And I think what you see is when you look at the underlying performance of our businesses, of our portfolio companies, they grow really well, and therefore we generate tremendous returns through the growth of those businesses. It's not a cost-cutting play. It's not a quick flip play. This is about sustainable growth in our companies, really well supported by our investment team and the other resources we have around that.
Any questions? Yes, Commissioner.
Thank you, Madam Chair, and, Linda, I appreciate the background on the committee. I wasn't able to attend this last time, but I think we got this, tax stabilization revenue investments, or reserve investments will be discussed with the team, so we'll be getting to those. Which is sort of to piggyback on how you choose, or how recommendations come to the council. I'm wondering, David, if you could give me some context to why the $100 million amount is chosen. I don't know, like it has to do with asset allocation, but like if you should give me just more context for why that, how you choose the amount.
Absolutely. So we are targeting a certain number of core managers. The math is not quite as simple in private equity because we have fund cycles and you don't know necessarily the pace of investment. But we're targeting a certain number of core managers, and we're also targeting certain ranges in terms of a GP concentration or a fund series concentration. So it kind of flows off of that. Advent would be a new relationship, so we don't necessarily have to worry about the upper limit in terms of concentration. So then we're shooting for 100. It appears that we probably won't get 100, but we would like to ask for 100. In terms of other managers, when we have a previous relationship that we've done well with and we want to add that fund, we have to weigh that all the time. How much is in the ground, how much the pace of things being sold, and also what we project will happen in the future. We do that, Chris Cassidy and I do that with our consultants, and we try to find that happy range where we're not overly concentrated on just a few managers, but at the same time, we're not overly burdened by too much.
So it has more to do with manager diversification, manager sort of allotment than it does asset allotment. Like, do you get a certain amount for private? Yeah, you do, because you have a
Yes, we do.
certain percentage of what we do for private.
Sure, yes, in the asset allocation that the council approves, we have targets 11-12% for private equity. And then we try to work within that range. We're a little bit low right now because we've had a high level of distribution. It's a good problem to have. Lots of managers selling companies and making money for us, so we can't put as much money into the ground. They're putting it, but they're also bringing it back. So we're still trying to get that target, and that's where the pacing model that Pavilion provides for us helps us to measure the allotment that we want to put out.
Anyone else? Yes, Senator.
Sure, well, I think we should have fun. So I just, being that this is a Democrat-controlled state, being that Romney and Bain Capital were pretty well demonized in the past, I just wondered if Mr. Hoffmeister wanted to tell us if he thought that his experience at Bain was an asset or baggage as you come on over that.
It's a really good place to learn, actually. Now you asked, it's a great training ground. Unfortunately, I didn't get to meet Governor Romney at all. You've gone to the Salt Lake City Olympics, but.
So it was a positive experience.
It was, yeah.
That's all.
Excellent sense of humor.
Yep.
Senator. You never know what you're gonna get here.
No, that's fine.
All right, yes, Mr. Treasurer.
On your fund term summary, which you've got, realized, unrealized? Is it, deal by deal? Is that incentivize more risk, deal by deal? And then, you mentioned already on the carried interest that prevents them from taking something early, but kind of walk me through it if you would, please.
Sure. So, the 130%, references an amount of, current value, so it's a combination of realized and unrealized value, below which the general partner will not take profit participation distributions. And that's a slightly long way of saying it's a cushion for the LPs, such that we won't run the risk of distributing every last dollar that we quote unquote earned, and then have a bump in performance end up falling into a position where we've over-distributed. So what we've tried to do is to suggest to our investors that at no time until the end of the fund, there will always be a 30% cushion of money that we've earned but have not yet distributed to ourselves. So that's, it's basically a cushion and a test, and it was increased from 120% to 130%, in part in light of the fact that we don't have a preferred return, so to give the investors some comfort that they won't be in a position where the GP is taking more than its fair share of profits.
And the deal by deal?
It is deal by deal distributions, subject to that cushion and subject to an end of the day clawback. Whereas at the end of the fund, we've over-distributed, we owe you the money back.
The risk with the deal by deal is, all their fund investments except one, let's say, is doing poorly. And then they realize that one, and then if it's a deal by deal, if they can take profits from that one, they realize even though the rest of the portfolio is suffering. And that's why the preferred return is a protection, but this one doesn't have a preferred return, but it has that NAV test that we talked about as protection. And then if by chance they do fall into a clawback, they actually have interim assessments too, which is different from some of the other funds we see that just do the assessment at the end of the fund. So if they do fall and they've overpaid themselves, they'll actually true it up on an annual basis after the investment.
And in the 8 prior GP funds, we haven't run into that situation. Performance has been such that we've always been ahead of or far ahead of that curve.
One more, I got it.
Sure, certainly, Mr.
I
Treasurer.
guess this is more, I guess for Vince, maybe, but by reaching out now to Avalanche, are we creating a competitor for people like BlackRock and some of the other ones that are already investing?
Well, Mr. Treasurer, in terms of competitor, I think the fund's probably better positioned to answer that. Are they playing in those same markets? We generally think, as Dave was indicating, we just want to have a diversified set of managers, not so much so that we want to get market returns. We need to concentrate some, try to get above market returns. So adding Advent's really just a manager diversification on our part. Maybe I'll flip it to you guys for the competitor.
Sure. We do compete with a number of different people, but we don't compete with any 1, 2, or 3 in particular. So the fact that we've got 5 sectors and the fact that we're investing globally around the world, in any given year, we'll see 25 different people that we're competing on deals with. So, and I think that'll probably be the case with every single one of your managers, hopefully. It's hard for me to speak to your specific portfolio, but for us, we compete with a lot of people. We beat them sometimes, we lose sometimes, we lose deals that we wish we'd won, and it's the very nature of the marketplace.
Last question here. The waterfall, is it European or American?
Well, we try to avoid those terms, but deal by deal is also. I try to avoid these terms.
Yes, Harold.
I was really impressed with the fact when we took a look at this, that it's firm owned, and it's not publicly owned, it's owned by the people who make the investments. Their livelihood and their futures depend upon how well they do, and I really like the fact they got skin in the game, and I'm glad to see something like that. So that made it real easy to be positive about this one.
Okay, Thank you. Anybody else? Yeah, Linda, I think they might be.
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Pavilion, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve up to a $100 million commitment to Advent International GPE F9 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate review.
We've got a second. Do we have any discussion about the motion? Seeing none, all those in favor?
Aye.
Any opposed? Any abstaining? All right, the motion carries. Congratulations, gentlemen. And we have our second action item. Yes. And that is platinum.
David, are you ready to go?
Absolutely. Platinum 5, we're here to talk about Platinum 5. Platinum 5, you're not going to hear the same story that you just heard. This is very, very different. Platinum 5 is a global buyout and turnaround strategy. Platinum invests in undervalued, undermanaged, and underperforming businesses on an opportunistic basis. So a few of the tenets of Platinum, they're very value oriented. So they're trying to buy at significant discounts to market multiples, and they're operationally focused. They have a dedicated team of over 50 experienced in-house specialists on the operations side. One of Platinum's main strategies, is to target strategic sellers. These are large companies with non-core or underperforming assets or divisions. Companies that they work with include Johnson & Johnson, Pitney Bowes, Staples, Caterpillar, Emerson Electric, Alcoa, Kodak, and Textron, and Jeep. So Platinum is also a large organization. It has 230 employees, including 140 investment professionals across 6 offices, 4 in the US, and then also London and Singapore. Platinum's strategy is actually sector agnostic, as opposed to a course sector strategy. They have a little heavier weighting in technology, media, manufacturing, packaging, and services, but they've also invested in transportation, logistics, materials, automotive, equipment rentals. They're looking at just about everything. Fund 5, you would target $8 billion and would be $10 billion hard cap. And for perspective, Fund 4 was $6.5 billion, and Fund 3 was $3 3/4. The investment check size, although average about $300 million, the historical range is pretty wide. Companies like AES, San Diego Union Tribune, and Clipper and Wind Power, the check size has actually been less than $10 million, and they have put a little over $700 million into a company called Husky. Husky. We expect Platinum 5 to have 20 to 30 platform investments. Geographically, Platinum's investments have been mainly in the US and Canada. That's 85% historically, with Europe being about 12% historically, and then a little bit of exposure to Asia. 4 to 5%, at least $400 million, will be the general partner commitment for Platinum. And in addition to that, they have an extensive co-investment program, which averages about 7% of each check size. So a lot of alignment on the part of the Platinum organization with its LPs. We should note that small cap investments, which are defined as less than $450 million in revenue and $45 million in EBITDA, will not be included in this fund because Platinum last year raised a standalone small cap fund. Relative performance is strong. Fund, as you can imagine, Fund 1 and Fund 3 are first quartile, and Fund 2 is close to the median. DPI, distributed capital to paid in, is first quartile for Funds 1 and 3, and Fund 2 is second quartile. have three funds, and our three funds have experienced a 21% IRR and a 1.6 multiple. On a nominal basis, the public market equivalent return over 14 and a half years, so 2004, is 26% versus 10% for the S&P 500. So staff and consultants are recommending a commitment of up to $75 million. And this would be our fourth commitment to platinum. We did commit $30 million to platinum 2, $75 million to platinum 3, and $100 million to platinum.
Just a clarification, the second time you said nominal. What do you mean by nominal when you refer to that?
I'm using it in terms of actual number amounts versus relative performance, which is the quartile.
Okay, I wouldn't use it.
And with that, I will turn it over to Alan.
Great, thank you, good morning. And just a note on process to clarify, this is the fourth investment with Platinum you're considering. But on every fund we look at, we do the same level of diligence. So the same level of diligence was done on Advent, which is a new manager to you, as is done on Platinum, which is an existing manager. And because in our experience, people change, the environment changes, the fund size changes, sometimes strategy changes. So it's important to look at everything from scratch. You do have to spend less time getting to know what the manager does. You can focus more time on other areas, but the same level of work is done. David did a good job of summarizing the merits, which while the strategy is different than Advent, a lot of the merits are the same when you look at it. Strong performance over a long period of time, deep and experienced team, those are all things that we like to see. And consistency across the professionals. A couple other notes I think that are interesting to see is that Platinum has been able to return capital very quickly. It's not that hard to put money out. It's much harder to get it back at a significant multiple to what you put in. And Platinum's been able to do that and do that on a timely basis, which is important. Which is in part the reason that we're focused on a commitment of the size, because they have a habit of drawing the capital and then returning it quickly. And they've also had a consistent strategy across the firm for a long period of time that's not market dependent. So a lot of times with firms such as Platinum, you might see that the strategy is dependent on a broad market downturn or a recession or something like that. Because they're very opportunistic and they look across sectors, there's always enough things to do, even in up markets. And so that's something we're confident in. In terms of the risks that we identified, a lot of things similar to what Richard identified in Advent is when the fund size grows, you want to see capacity. You want to see what's changing. Are they fundamentally changing their strategy to match the fund size? Are they adding resources to the team? I think in Platinum's case, the thing that we've seen that's interesting is that their larger investments have done better. Because now they can play and buy things from the likes of GE and J&J and Caterpillar and others. They can buy these sizable divisions, carve-outs that have a lot of opportunity to expand and improve. They have had some turnover, but because of the depth of the team and the consistency of the senior members of the team, that was something we were able to get comfortable with. There is concentration of the economics amongst a smaller group of people, but that has been improving over time. So when you look back to where they were in Fund 2 and where they are going to be in Fund 5, a lot of that has changed over time. And I think the other thing to remember is that, if you're getting 5 points of carry in Fund 2, 5 points of carry in Fund 5 is significantly different given the fund size, so a lot more dollars in terms of absolute economics. And then there have been situations where there's potential conflicts of interest. What we like to see is folks are always going to run into situations that are complex and can potentially create conflict. But Platinum has done a good job of being very transparent in those situations and working with the LPs, keeping the advisory board informed and keeping the broader LP base informed. So with that, I'll turn it over to Mark Dardenhill to make his presentation.
Governor, Senators, and Council members, so good morning. Thank you for having me here. And before I talk about Fund 5, thank you also for your partnership. We do not take lightly the commitments you guys have made before. We believe we've done a good job in managing those investments today. We still have work to do to bring them all the way home. Look forward to talking about that as me spend just my brief time, and I don't wanna take a lot of time, but putting a little bit of a face on our firm. As these guys just noted, we're a bit different from the admin guys, and describe how we're different and why, and then kind of open it to your questions to talk about. We are, I think we're just an unusual animal in terms of private equity firms, largely because we didn't come from finance or private equity or investment backgrounds, we came from operating backgrounds. Everybody in this firm, at the founding level, and I would say more than 90% of people in this firm today, didn't come from Wall Street, they came from operating companies where they work inside the business, and the very model developed as a consequence of that. So the things that were important to us as we started to look at prospective investments were much more focused on what was going on the factory floor, inside a business, what were the levers of control we could bring to bear operationally to improve that business, as opposed to more theoretical kind of financial engineering that if we buy at X and we sell at Y, we get a little bit of uplift in the lending market, we're all gonna be rich. It just never worked for us. We've always been much more, I think, pragmatic in the context of what are we buying, what do we own, and how do we make that work. That led to a development of a strategy and a team that is fully integrated. We call it M&A&O, typical private equity firm. The advent guys or whoever you're going to talk to, the M&A guys run the front end of the deal, they buy the company, and then they hand it off to somebody, in their case, their operating partners, consultants, to work to their model. That's, again, never worked for us. Our operators are built into the process. And at the first management presentation, working on the deal and working on identifying what's going on inside that business and what we can do to fix it, and then what we should pay for it, what we should, what the value of the business is. And it's really important also in our model that we pay for what we're buying today. We don't throw an extra turn or multiple in because we think we're going to be able to generate gains after we able to exceed that. We want to buy what we're getting. We don't want to pay the seller for what we're going to turn it into. So M&A&O is kind of our differentiator, and it's different at all levels. We're also a bit different in that we have always had a principal investor's mindset. We started with our own money, just $200,000 of it actually, and started shepherding into deals. When we got to the point ultimately where we were generating deal flow and we had the capacity to do more than we could simply fund ourselves, and we raised that first fund, it took us almost 2 years of convincing ourselves that we wouldn't let that change us. We didn't view ourselves as managers of other people's money for a fee. We would learn to do that well, but we viewed ourselves as entrepreneurs and investors. When we raised that first fund, it was seeking investors to stand shoulder to shoulder alongside us, bring money into the deals together and generate good returns. As a consequence of that, we've always been the largest investor in all of our funds. As you guys mentioned, our GP commitment will be in the 5% range. We'll in addition to have that between 8 to 10% co-investment. We'll have more than $1 billion of our own money in this fund alongside yours. And so we promise you that we'll treat your money like it's our own, because it is our own alongside on all these transactions. So what do we buy? We buy operationally undermanaged, underperforming broken companies. In the early days of the firm, it was fairly focused on broken businesses that had good transformations, and the levers we used from an operational standpoint were relatively basic. It was you control the cost structure and collect receivables. You'd be surprised how many companies can't collect receivables. Over time, as we have grown, we have
I've been explaining that to our tax and revenue.
Right. Yeah. Surprised today, we've been doing this for 22 years now, and you still are.
See what happens when you're not in the meeting? I'm kidding.
So those tools are relatively rudimentary. Over time, as we've grown, and the advent guys made a point that I think is important. As you grow, you can't just grow fund size and keep doing the same thing. You have to evolve. And that goes to what I suppose I'll close on here, to tie back to what these guys said, is the risk question. What's the risk equation for a firm like ours? It's the scalability as we continue to grow into larger funds and larger, more complex transactions that require more sophisticated tools to get at the operational levers of value creation. And in that context, we've spent a lot of time over more than a decade now really building on that original definition of what the O was, manage the cost structure and collect receivables, to build on top of that, additional capabilities with respect to merger integration and overall operational excellence. Built on top of that, not just the cost side of the equation, but the growth side, looking at things like go-to-market strategy, pricing, supply chain optimization, and then finally on top of that, we built a technology piece as well, how to build technology tools. So we've been very aggressive in scaling our, not just our team, and not just our fund size, but our capabilities, the toolkit we use. We have a much more muscular operations organization that can now go to market. And again, what we're looking for are not particular sectors or companies in those sectors. We're looking at operationally undermanaged, underperforming businesses, and that allows us to buy across a full cross section. I'll just give you 4 examples, one into the other. We bought, you own, a company out of Johnson & Johnson last year that is a healthcare services business, very sophisticated in terms of blood glucose monitoring. So we have technology transformation now from pinprick and scripts to continuous glucose monitoring. We're in the process of carving that business out of J&J now, standing up as a standalone company. We also own a much more prosaic business that manufactures screws and nails that go to the hardware store. If you go to the hardware store and you buy grip type nails, those are manufactured by a company of ours called Prime Source. We're in the process of carving that out of a large Japanese conglomerate and standing it up as a standalone. We also own the largest government services contractor in the world. It's a company called PAE, used to be Pacific Architects and Engineers, grew up out of Lockheed Corporation. We have employees on all 7 continents, doing everything from food service and maintenance and security to visa processing in embassies and consulates to 1,000 people on Antarctica running a science lab for the National Science Foundation. And then the opposite end of the spectrum, we have an equipment rental business that is the largest provider of portable toilets to construction sites around the country. Those big porta sands you see. Each of these very different, diverse markets, very different, diverse operations, but fundamentally one thing was wrong. They were undermanaged. They were underperforming. They had a management team, a parent company that didn't know how to optimize their performance and generate return. We believe if we can acquire those companies, look at a transformation over a relatively short period of time, create value, divest that, and bring that money home to our investors. With that, I'm going to pause and open it up to any questions.
Questions from the members? Yes, Senator Jones?
Just who are the underperformers in those porta potties?
That's a very interesting industry. The company we own has almost 20% market share. There's nobody else in that business that has 2. It's a conglomeration of small mom and pop regional players. One of the reasons the business came available to us is there was an attempt to try to consolidate a number of those, and they were just the merger was just a disaster. The companies, or the acquiring companies that started to roll these up, its inability to establish common billing and inventory management and all those kind of pieces, delivery systems, they just stumbled, they broke, and they sold in part for us to be able to come in there. So that the truth is, the underperformer is the big dog itself, this 20% market share business that just hasn't been able to digest those businesses well. It hasn't been able to manage that merger integration in the proper way. And it's one of the things we do well. We've been doing it a long time. We know a lot of M&A deals, a lot of LBO deals fail because the merger integration fails. You can't bring cultures together. You can't bring building systems or ERP systems or any of those things together in a timely way, and business stalls as a result.
Anything else, Senator? Any other questions? And a sidebar. Scott and Commissioner, do you have anything?
We wanna know if we can get Pistons tickets.
Yeah, we did for a while when it was quite Pistons. We pledged to our investors when that business reached the end of its turnaround phase, it would we would take the fund out of it, and we did that at 2+X multiple. So you don't own the Pistons anymore. I can't get you tickets, but it's
And
just
then
like
ask Ashley.
it's just like getting anything
Mark,
else.
will you just suspend, I
Yeah.
only know how to do a congressional hearing, so
Yeah, sure.
the lingo is you suspend.
Yeah.
And while I'm happy that folks are more engaged as a group, I can't hear. So if you would help me out so that I can hear Mark's responses, and then if you've got a question or comment, I promise I will call on you. Thank you. Go ahead, Mark.
So the answer is in the same way, you know, I can get you screws out of the hardware store or anything else. I can get access, but you're gonna have to pay for it. That's the nature of running these businesses in an efficient way.
Okay. Are there any other questions or comments? Yes, Mr. Treasurer?
On the last risk and the last comments about the mitigation, can you give me examples of other companies that do this? That's on the page.
I'm sorry.
So in the,
Operational, internal operational and fee structure that they charge instead of using third party.
okay, so what's the specific question is on the monitoring fees? Yeah, so, and I'll let Mark, build on this, but typically what we see is when firms, when the, manager charges the portfolio companies for services, the fees that they collect from those portfolio companies get offset against the management fee. But the firms all have different models. Some firms don't have operating teams, but they're charging their portfolio companies. Other firms have very large operating teams. I think Platinum's is around 55, 60 people. So that costs a significant amount to run that team. So what Platinum has agreed is that when they collect from the portfolio companies for those services, because effectively without that, they would have to go out and pay for those third-party services. Platinum provides that, they collect a fee, they collect, once they hit a threshold, which is 25 million, which helps fund their team, anything above that then goes to the offset. So it puts them a little bit more on even footing to help pay for the services, because their management fees are a little bit below what we've typically seen in other funds.
Yeah, Mr. Treasurer?
But you've seen this in other stuff.
Yeah, we've seen iterations of this.
Whenever you're dealing with organizations that have sort of larger operating teams, we have current managers that also have larger operating teams. You'll see things like this.
You should see in every fund you invest in, some sort of an offset mechanism, where if it's not monitoring fees, which are typically used to help fund operations, transaction fees, breakup fees, or topping fees, any of those that are collected by the manager typically are gonna be offset against your management fee and lead to a reduction in your management fee. You know, we have, listen, our view from the beginning has been, you know, management fees themselves, with respect to the headline management fee around the fund, we've never been very interested in collecting those management fees, honestly, because number one, the rented money, we gotta send it back to you with the pref, and number two, it's money that isn't being put toward investments that we're gonna have. So we've always managed, you know, the first fund, I don't think we took any management fees at all. In the second, third, and fourth funds, we took only kind of the very beginning before we started to get into it, transaction-based with the monitoring fees. We've always looked toward those kind of monitoring fees and that offset formula to reduce the amount of your capital that's being put to work on fees as opposed to investments, and to, at the same time, as Alan knows, help fund some of the heavy lifting around turning around some of those companies. So that structure is gonna exist in just about every fund you look at. The fact that it's heavier in ours in monitoring fees, you'll tend to see mostly in those operations-focused firms that have a lot more operation boots on the ground.
Go ahead, Mr.
Just
Treasurer.
to follow up on that, but in this particular one, you're charging us more fee than the highest fee I've seen at 1.65%.
No, there's been higher fees. A lot of the fees are between 1.5% and 2%, depending on the fund size. So, but the fund size matters, obviously. 1.5% on 10 billion is more money than 2% on 500 million. So, but their fee is right in line, and probably the step down is a bit lower than what we've seen on some others.
And I would also say that if you look back at the amount of fee that's actually collected, it's substantially below that, it could be here as well. At one time, 6.5 really sets a headline management fee that establishes a cap on those monitoring fees. If there's any excess over that, for example, if let's say $100 million eligible fee, if you take 120 million in monitoring fees in any given year, the offset can't go down below zero, so you carry that over the next year, and the next year, and the next year after that. And you return that at the end to those investors that have of which there's a net fee excess that carries over years later on the collection of fees. It's not a percentage that we will collect from you. We will pull the data. These guys don't already have it in terms of what we actually collected in management fee versus what the headline management fee was, substantially below that. It was 0 to 2 on 21. Was the spread.
Okay, anything else? All right, seeing no other questions or comments, I believe we're ready for a motion.
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Pavilion, SIC staff, and the General Fiduciary Oversight Body pay, I move that the State Investment Council approve up to a $75 million commitment to Platinum Equity Capital Partners 5 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
We have a second. Do we have any further discussion, questions, or comments? Seeing none, all those in favor, say aye.
Aye.
All those opposed? Anyone abstain? The motion carries. Thank you very much, gentlemen, for your presentation. All right.
Thank you, Carrie.
All right, we are on item 3D. And that's the non-core fixed income global infrastructure partners spectrum. Those folks come to the table.
Hello, I'm Clark Stuckey. I'm joined here with Jennifer Wildman and Tim Ness of Axia, and also Jennifer Powers, the partner and chair of GIP Credit.
Good morning.
Today we're bringing forward the GIP Credit Spectrum Fund. They're investing in core infrastructure debt. Staff and consultants are proposing a commitment of up to $200 million to the fund. $100 million of this will be for the underlying funds, and up to $100 million for possible co-investments. Co-investments come with no fee, no carry, so it effectively cuts the fees in half. SIC, as Linda mentioned earlier, has experience with GIP. We're invested in the real return portfolio in GIP Fund 2. To date, we have a 21.4% net IRR on this one. This one fits into a lot of the themes that Vince was mentioning earlier about the current economic environment. We see this fund as fitting well into our non-core portfolio. A high proportion of our returns are going to be coming from income. Expected cash yields are 5 to 7%. For the Spectrum Fund, and infrastructure debt will help diversify our non-core fixed income portfolio, whose main risk right now is middle market corporate debt. And infrastructure companies their revenues tend to be less sensitive to the economic environment. The Spectrum Fund will fit into the lending strategies portion of the non-core fixed income portfolio. You can see on page 287 of diligence listing of the subcategories of non-core, and this will leave us fairly well balanced between our subcategories. And now I'll pass it over to Jennifer and Timothy of Axia for more detailed review.
Thank you, Mark. Thank you, Governor, members of the council. Bart covered it pretty well. I mean, the non-core part of the portfolio has been growing. You know, it was put into effect about 2 years ago or a year and a half, and you know, we've been growing it sort of slowly, measuredly. I think you mentioned, you know, we don't want to do too many things in 1 year at the same time. We want to be careful with the pacing. But we've grown it in a pretty balanced way. You know, between the 4 sectors. We've been a little more focused in the recent year on structured credit and on distress, and you know, given a lot of what Ben says, this is sort of to protect against the credit downturn. These managers and buckets tend to be a little more flexible. They can be a little more opportunistic and take advantage of any sort of credit downturn that other parts of the portfolio are much more focused on the corporate side. So this will diversify the asset base a little bit, and this will be actually their first infrastructure debt fund. We'll also, going forward, look to diversify in terms of geography and in other ways, but this is sort of the first foray into that. And then, once this investment, is approved, the unfunded commitments plus the current NEDs will really keep things balanced, so you're gonna have sort of, very equal, allocations to the structured credit, to the stress, and to the lending bucket. This, as you mentioned, this is our first foray into this. We have a good relationship with, the infrastructure partners. They've been around a very long time, been doing this since 2006, been doing the credit side since 2014, so, we like, this as a potential partner for the first investment. And Linda gave a bit of background on how, things are approved at the investment, committee level. Ken will give you a little bit of background how we look at the managers and what we sort of focus on in the course of our due diligence.
Great, good morning, everybody. As Jen mentioned, we reviewed GIP's new Spectrum Fund for consideration in the non-core fixed income portfolio. Similar to our prior reviews, our analysis consisted of investment due diligence, operational due diligence, and a legal review. What that means is we have numerous calls, on-site meetings with the manager. We provided them with some data requests, we run background checks, along with a host of other analyses consistent with all the considerations that we mentioned earlier. As way of background, as I'm sure you guys are familiar, GIP is one of the largest infrastructure investors in the world, with upwards of $50 billion of assets under management, 140 total professionals, and about 100 investment professionals, including a large operational team that are experts in this field. Within infrastructure, the real areas of expertise include energy infrastructure, water and waste projects, along with transportation assets. As Jen mentioned, prior to 2014, the firm's main strategy was really around private equity infrastructure investing, but since that time, they've really been building out, have built out their credit capabilities. They offer two credit strategies. The first one that began in 2014 was what they call GIP Capital Solutions, or CAPS for short, which is really their sort of higher octane, higher yielding strategy, which may include more subordinated debt or preferred equity. In the portfolio, what we're talking about today is the GIP Spectrum Fund, which is going to be more senior focused and more stable project, generally speaking. This will include senior debt first and lien across private, public, and some syndicated credits within the four verticals, and is targeting around 7 to 10% of gross return. The team's been led by Jennifer Power since 2017. The credit team has been led by Jennifer since 2017, and includes 12 dedicated investment professionals. They've recently recruited 2 senior professionals from Barings Global Infrastructure Team to lead the Spectrum, certainly on the origination side, to lead the Spectrum investment effort. We noted the credit team also benefits from the broad research to the firm, which creates synergies with the private equity platform, as well as the operational professionals that they have in-house. And I would mention, just for reference, the PE team has deployed upwards of $25 billion historically, and generated, as Bart mentioned, on the last fund, IRRs generally in excess of 20% in the last year. Key terms for the Spectrum Fund are as follows: they're raising a target of about 1.5.
Can I ask you to suspend? I'm sorry, I cannot hear. Okay, thank you, Tim, I'm Scott. Tim, go ahead.
Yeah. So $1.5 billion target fundraise. The management fee for SIC will be about 1.1% blended, because there is it steps down as your investment size grows, and that's on invested capital, not committed. The carried interest is 10% over a 5% preferred return, and the investment period is 4 years. And importantly, I would note that, and emphasize what Bart mentioned, that to the extent that we will get no fee co-investments, that will blend all of those figures down. Following our due diligence, what are some of the items that we like? First, this presents an opportunity to partner with one of the top infrastructure investment platforms in the world. Their credit team is quite seasoned, as I'm sure Jennifer will point out, and their professionals share, even though it's a newer platform, they share a common work history, and so it feels like they've been very, very thoughtful about the build out of the team. overall, we think the opportunity set is still attractive, very large. Infrastructure project finance is one of the areas that regulations of foreign banks have really hurt their ability to fund some of these projects, particularly to non-investment grade or private borrowers. I would mention that GIP's ability now, given with their spectrum fund, their caps fund, and then the equity side, the ability to work with a borrower to provide capital up and down the capital structure and in size, we think is a capability that really makes them highly relevant for borrowers and sponsors and certainly partner peers. Finally, I've noted that infrastructure can offer attractive returns that are a little less correlated to some of the broader market factors. Typically, these loans are collateralized by hard assets, which have some contractual cash flows often from an offtake party, providing good visibility into a borrower's ability to service debt. And further, these loans typically come with sort of covenants and other minor protections. Of course, the investment entails some risks and other considerations, which we point out in the report. First, we mentioned Spectrum as a first time fund series. So the senior part of the strategy is new. And in general speaking, the credit platform is a little, it's still a newer part of the platform. We mitigate this back by just the fact that GIP's been around for a long time. They have a tremendous reputation, they have established processes, vast relationships, et cetera, all factors that we think should help them be successful in the credit endeavor. The other thing we mentioned is that there are the potential for conflicts between what goes in the cap strategy versus spectrum strategy, because the sort of dividing lines are on a level potential return. Again, we spend a lot of time looking at their allocation policy and understanding some of the factors that they would consider beyond just the return around how they determine allocations. And we noticed that this is not at all dissimilar from other private credit funds that we see, where you sort of bifurcate the strategy based on risk and return. So finally, overall, as Jennifer and Bart mentioned at the onset, we consider this investment to be complementary to existing positions in our fixed income portfolio. And I'm happy to field any questions now. If not, I will reserve it to Jennifer.
Any questions for Tim? Okay, Jennifer.
Thank you, Governor, and thank you, members of the council, and it's a pleasure to be here. I would be remiss if I didn't thank you for your investment in our equity fund, GIP2, which, as Bart mentioned, is doing quite well. Another reason I'm really thrilled to be here, and frankly, being third and hearing some of the themes that have come up gives me a chance to address everything head on. But most interesting to me is the two themes that came out in terms of preparing for the down cycle, which is something we believe in very, very strongly at GIP. We can debate when that downturn is coming, but we think that the credit cycle and getting closer to real assets and building in the types of robust protections is the right time and the right place for where we are in the macroeconomic cycle here in the US and globally. And second, it's not often I get to come and say I'm doing something that directly benefits the state of New Mexico, but it is a pleasure to say that we closed a deal yesterday for our CAPS fund, but it gives you a sense of thematically for the EPIC crude pipeline, which will serve, amongst many other constituencies along the line, Lee and Eddy counties, and the producers in the southeast region of New Mexico and the Permian into Corpus Christi, and then export into international markets. So, we're very much energy focused within GIP broadly amongst the three pillars of our sectoral focus that Tim mentioned, and it's nice to say we just closed a deal with New Mexico. So with that, let me just riff on a few things that Tim and Jennifer and Bart had mentioned. GIP is a pure play manager. We've been at this for a very long time, before infrastructure was trendy, quite frankly. All of our team within GIP has a long history of working together. And although Tim called out that I've been with GIP since 2017, I actually grew up with the founding partners of GIP back in our investment banking days at Credit Suisse. So even though I've been back at GIP, within the family for a year and a half, in dog years, it feels, 10 or 20. And within the build out, this is something else I'd like to flag because it came up with Evan and Platinum to some extent. As we are building the credit business at GIP, we're very mindful that, again, this sort of investment strategy is not scalable per se. So over the past year and a half, we have brought on board a number of additional resources within credit. But again, the theme so broadly within GIP is that we've all worked together in the past. And the two folks that are focusing on the spectrum strategy worked for me in my prior lives, if you will, at Credit Suisse and other organizations. So we all have the same investment philosophy. And that string pulls through the entire firm. We have a common investment committee across the equity and debt platforms. So the fidelity to mission is very consistent across our investment philosophy. Another thing that came up, which I think does bear flagging, is skin in the game. I think somebody said it over here. And everyone on the team is invested in the funds, both on the equity side and the debt side. There's no siloization in terms of process. We think the ability to leverage the broader platform, whether we're talking the equity side of the house or the debt side of the house, is what we offer you as investors in our fund. And so my team, broadly defined, including the ops team, which I'll come to in a minute, all has substantial economic ongoing interest in investments, helps keep the eye on the ball at every step of the way. In terms of what we think of as our special sauce, and again, I'm sure it's not a coincidence that the funds that New Mexico State Investment Council is focused on do have a very high operational touch. And within infrastructure, we think that's incredibly important because there is a misnomer within the infrastructure space generally is that these are, kind of sleepy assets. You can, lock down margins with long-term revenue contracts or regulated cash flows, long-term feedstock contracts, clip your coupons and sleep well at night. Our view is that infrastructure assets are highly, highly complex and you have to really have your operational eye on the ball. And as such, our firm was founded from the basis of an operational team that came on board from the Jack Welch era at GE, as well as some folks from Honeywell, 30 folks strong, with decades and decades of experience building complex infrastructure projects, as well as the investment team that originated from Credit Suisse. And what we've been able to do on the credit side is take this incredible resource, which has been focused on optimizing upside on our equity funds, and focus it on really helping us create that robust downside protection. And it should be contrasted in terms of how infrastructure lenders generally behave in the market. If you're an infrastructure lender, you go out and you hire a third-party consultant, an independent engineer, and that independent engineer gives you a report and says, here are the risks. And you as a lender get to do the tummy test, as I call it, that says, am I getting paid for the risk that's being presented to me? And if you like it, off you go. And that independent engineer exits stage left. No skin in the game, no eye on the ball, good luck with your investment. We have a completely different approach. We have this 30-person operating team that works with our investment team to really reconfigure the risk. We look at assets on the credit side and we ask ourselves, what would we do if we own the asset? How would we work with that borrower to create the types of robust protections up front so that we're much more comfortable with the risk profile of the asset? And once we can do that, working very, very constructively with that borrower, putting in place those protections, then that ops team, who also has skin in the game, is helping the investment team keep an eye on the ball. Because in the land of credit, you don't start out with an investment and then love it and then find a way to the workout or bankruptcy court overnight. It's a slippery slope, and we think our ops team can really help keep our investments on track, which has been the practical experience that we've had on our capital solutions fund. So that's kind of the backdrop operationally. As Tim mentioned, our thesis for Spectrum is a 9% average gross return. Our hunting ground, as I like to call it, is 7 to 10%. And then caps picks up at the 11% handle and will go after the type of prep and slightly more high octane investments up through 14%. Then our equity side of the house picks up at 15% onwards. What that allows us to do in the credit space is cover the full private credit continuum, really sitting with borrowers and creating the types of customized solutions in the private credit market, which is highly opaque, that allows us to get the covenants, the ring fencing, the informational reporting that we can really use to protect the investment long term. So that's a key feature in terms of our thinking. The other thing that I would just mention is it came up was regulatory dynamics. Sometimes people ask, how can you get 9% on credit in senior secured loans? Well, the answer to that is truly about the inefficiencies in the private markets as a result of Basel III, Frank-Dodd, Volcker, Insolvency II. And the markets are a tale of two markets, the haves and the have-nots. And if you're a large mid-cap company with a 500 million of needs, you can check all the boxes, off you go to the bond market. And we love it from an equity side of the house where our equity companies borrow. But as a lender, we don't like the public markets at all because we don't see the bubble environment with the lack of covenants providing the right offsets on risk. So in the private space, we're very focused on the types of opportunities where a borrower may not have access to the broader capital markets or to the banks who don't want to be banks anymore, don't want to lend, and how can we work with that borrower to provide the type of capital that best fits their needs. So we see tremendous opportunities within the credit space. As Tim mentioned, Spectrum is an outgrowth of our experience on the Capital Solutions Fund. We, over the past 3 years, have uncovered over 20 billion of opportunities that uniquely fit the Spectrum space, as we call it, and we're highly confident that our deployment rate, in particular, as we enter into perhaps a slightly more volatile market environment, will put your money to work in good order and good pace over the next several years. I'd love to take any questions about infrastructure, energy, anything on your mind.
Thank you very much, Jennifer. Yes, Linda.
Do any of your credit funds provide financing for the companies in your equity fund?
Thank you for asking that. We are hugely conflict averse, so we do not lend to our equity companies. And in much the same way, we will not have Spectrum and caps be at different attachment points in the same capital structure because we don't want that fund conflict between LPs. I know the managers somehow find a workaround to make that work, but we just prefer not to.
Anybody else? Yes, Mr. Treasurer?
Thank you, Kevin. My sticking point when I looked at this was the co-investment.
Mhm.
So, and I guess this is more of a question for you or for Axia, but what's the due diligence? I mean, we're handing them another $100 million and saying, do with it as you please, so, I mean, I don't know, I think we got it.
Can I take a shot at it and then you did something? So it's subject to all of the same diligence that you're trusting us with in the first $100 million. Okay, so from the standpoint of our underwriting policies and everything that goes into that, we are confident whether you're investing $100 million or $200 million, the same applies. The value of the co-invest opportunity, we think, from an investor standpoint, is that it allows you to be more significant within our family of funds. We've talked about relevance. We've talked about inviting New Mexico onto our LPAD board. But really, the benefit of the bargain here is that you'll have limits subject to what Bart and the team come up with in terms of how much additional exposure that you want to put in any incremental co-invest opportunity. But the real value of the co-invest is that you substantially buy down your fee and carry schedule to extremely competitive rates. So it gives you the opportunity to put a little bit more assets to work under the same underwriting paradigm as the main fund at a substantially lower cost structure for all of your funds.
Any other questions or comments?
I might just add that
Okay.
SIC perspective to the co-invest. And one of the nice things about the way GIP does co-invest on their first credit fund is that most of their individual deals had co-invest with it. So the one thing you worry about with co-invest is diversification. And so with that experience and with limitations on each individual co-invest deal, we think we'll have a nice diversified co-investment fund.
And we're very confident we're going to give you your full co-invest opportunity, because the nature of the private markets is average deal size, 250, 300, 400 million, yet we only take into the main fund 100 to 125 million. So by definition, we need our co-investors to kind of top up so we can speak for the full capital need of the borrower.
Okay, thank you. Anyone else? All right, Linda, I think we're ready for a motion.
Based on the recommendation of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and the General Fiduciary Oversight of RDK, I move that the State Investment Council approve up to a $200 million commitment to Global Infrastructure Partners Spectrum, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Do we have a second, Harold?
Yep.
All right, any other discussion, comments, or questions? Seeing none, all those in favor say aye.
Aye.
Any opposed?
Mark me as a no, please.
Okay, so the treasurer no, Scott Smart no, all right, any abstains? All right, Linda?
I always ask, it would be helpful for both the investment committee and the council to know the basis for the objections as we look at future investments.
I know for myself personally, I couldn't get myself comfortable because this is nothing against the GIP folks. This is a new direction, so there's no track history for me personally. And I don't like being first in line when someone's doing a new type of investment strategy. And the next comment's just my own personal thing, but I noticed in reading the documents that our advisors, when they were doing due diligence, asked questions about the finances of the general partner and some employee departures, and they didn't get answers for those. And I'm just a full transparency. Now, these are taxpayer dollars, and I think if we're asking questions on behalf of the taxpayers in New Mexico, we ought to get the answers, but that's just me. Again, not a knock against GIP at all.
I completely get the answers.
And although I like the fact that your waterfalls in America, and that your, that your fees are good, I just felt uncomfortable with the co-investment. I just don't think that the diligence, you didn't convince me that the due diligence is going to be the same.
All right, thank you. Any comments? I did hear, based on Scott's comments, thank you very much, both of you, for your feedback. The answers to the questions about the partner's departure, et cetera, was answered? Yes.
There have been no partners, with the exception of one, about 6 years ago, that has left the firm. And they retired, I guess fishing was the option. And we had, our chief risk officer retired, who was subsequently replaced, that was shared.
And that can be sometimes
Yeah.
the 10-minute report, so once it's published, and have to follow on it, but, you know, many times can be done.
Peter?
I really appreciate both of you explaining the position. I would just prefer in the future that you bring those issues before we vote, so that others of us can consider whether it would affect our position or get the answers. But anyway, it's wonderful to have this kind of transparency as to why we take the views we can take.
Agreed, Peter, not that the timing is, I may not agree that sometimes the information or your cost for concern is related to the presentations that we get on site. Can't always create a parameter for that kind of time frame, but I do think this is an important dialogue. Appreciate Linda's follow-up question and very much appreciate both the treasurer and Mr. Smart's comments so that we work as a body to provide to the public and to each other a sense of where our priorities are, or commitments are, or questions, a full analysis and discussion about strategies. So I think that is all very productive. I appreciate that too. Okay. However, we did approve, so congratulations.
And we will take good care of your money, and the level of diligence is not to be believed.
Thank you.
Thank you.
All right, we are now on item 4. It is our CFO report. What?
Governor, other members of the council, I will be on page 339, just a couple of things to point out if I may. I really don't have any comments on the first 2 items on the talking points, but I did want to point out on the agreed upon procedures. Hopefully by March 31st, we will have the reports for the first 2 quarters. I will be distributing those once I receive them. I did get a question here recently, why are we doing 2 quarters at once? That first quarter timing is pushed a little bit so we can complete the audit for the prior fiscal year. So that's the reason that quarter is being completed at the same time as the second quarter. And then on item number 4, this is a follow-up item, and I should tell Secretary Paddy Jackson if she has anything to add, please feel free to do that. We did have, based upon a question that was asked at the last council meeting, we did have a conference call on March 8th, and we had representatives from the SBIC, DFA, Palaka CPAs, the State Investment Council, the audit firm for the CAFR, and I think it was a very productive meeting. We did decide, and I think this is something that we all agree on, that the recording of the distribution to the SBIC from the SIC to the SBIC as it was recorded was correct. So we didn't have anything to report there other than we did decide it was correct. Based upon that conference call, the controller for the state, Ron Spillman, did bring up an issue, and I'm not entirely sure. I've seen some email traffic since that conference call. He did make a suggestion to the SBIC that their audit be conducted in accordance with GASB, since the SBIC is rolled up into the state CAFR. I think that's something that has not been done in the past. I also think that he had some discussions with the state auditor, and this is another issue that I think if there's any really great thing that happened as a result of this conference call, this issue came up. So we're waiting to see how that plays out, especially with the additional distribution, the 1% that is planned for the SBIC in the future. It's going to put their assets of probably over $90 million. A GASB audit, I would highly recommend that be done. So we'll report back on that later, but that's something that is on the focus of the controller for the state as well as the state operator. Did they indicate why they were never cited in the past for not having a GASB compliant audit? Scott, I went back and looked at past audits. The SBIC in the past has been reported as a not-for-profit. In 2017, they converted to a standard that was not even GASB, it's for small businesses. And that came on my radar. He talked about like a kind of hot button. Once I read that, I did get in touch with the controller for the state, and he said that this was already on his radar. But if it's not a GASB audit, it certainly should be a GAAP audit, which would be more financial. So I can't answer that question. I do think we're on the right course for the future, and we'll see how it plays out.
Do you have anything to add, Secretary?
Please, thank you, Madam Governor. So just, I agree with everything that Brent said, and the only thing I would add couple of things. One is that we did talk about changing, adding a little bit more detail to the note in the financial statements so that it's more clear as to what that revenue is. And so it would be something like contribution from the state of New Mexico severance tax permanent fund pursuant to the proper statute. And so once again, just kind of clarifying what that is so that if an investor wanted to go and find out more information, they could do that. And then the other thing is that Brent is right. The state controller did recommend and does believe that these audits or these financial statements should be completed under GASB. But he's going to go ahead and put together a full recommendation, and that will be obviously up to the board of directors to make that determination. But he has been working with the external auditors on thinking through that. But once again, it would just be a recommendation. That's all. Thank you.
Any comments? Questions?
And then, finally, actually two more items. I did point out in item number 5, in House Bill 2, we didn't see this coming. We've had questions in the past about additional inflows to the tobacco severance fund, or the tobacco settlement fund, I should say. And we did note in House Bill 2 that there is a planned $40 million infusion. If you recall, in 2017, because of budget pressures during that fiscal year, we transferred out over $109 million. So that $40 million is, in my mind, at least partial replenishment of those monies. And then I know earlier, just so everybody's on the same page, we talked about the revenue stabilization fund. Just be aware, getting into the new fiscal year 20, you will see, as part of the investment holdings report, that new fund as a new permanent fund. So just be aware that that's going to be happening, and that's something we're planning to do in the near term, get everything set up to allow that to happen. So, any questions on that?
So starting the fiscal year, starting in July.
I believe it. I believe it will be in line with the new fiscal year.
Any other questions or comments? All right, Brett, thank you for your report. We are now on item number 5, closing matters. So we've got a legislative update and the New Mexico private equity update. So, Ross, we're back to you.
Other members of the council, so I'm looking at page 369 through 70 in your book. It's just a short list of the bills that we tracked that passed on the front page, and the ones that we were tracking that did not make it on the back page. Just to hit the highlights here, I'm going to concentrate on the bills that impact the funds that you oversee. House Bill 393, as you know, and we've been talking about the rainy day fund, the tobacco, or the tax stabilization return. We expect to see about $650 million, and we'll look at an asset allocation recommended to you next month. Senate Bill 535, Senate Bill 401 also. This one won't impact the TSR until fiscal year 2022, but it could start delivering about $45 million per year from federal mineral funds that will flow into this fund instead of into the general fund. So it's another growth element that you may have to deal with when it comes to the tax stabilization reserve. Some other bills that send some money your way, Senate Bill 535. This was passed unanimously and actually does two different things. It caps how much can be issued in supplemental severance tax bonding this year at a fairly low number, about $181 million. So that, in theory, should direct more money to the severance tax fund. And then also it guarantees, it basically intercepts the intercept and guarantees that we are going to be in line for $24 million, or just a little bit under that, every year for the next decade. So those years where we say we only got $37 this year, we aren't going to be saying that anymore. We are going to have some inflows, and of course, as you know, that's been a problem in helping the severance tax fund grow. the legislature did a very good job addressing those. They also created a rural library endowment. Senator Ortiz, out of Albuquerque, had an idea about using some of the cash that we're seeing right now to create an endowment to fund rural libraries around the state. The bill and the structure passed, so you will have a new permanent fund. Actually, it is in that part of the statute along with the other permanent funds. What you don't have is a lot of money for that right now. Only about $1 million made it through the process, and that will flow into this fund. The fund is to be invested as the land grant fund. That language is a little problematic. We've seen it before. We identified it as an issue, but the bill moved forward anyway. We're going to have to talk to some of the folks associated with this fund and how risk adverse they are. I think early days when there's not much money, we'll definitely take a more conservative approach to investing that money. Senate Bill 10, this was the governor's bill on for the SBIC. We're going to double the allocation, which should provide about another $50 million in funding to the SBIC. They have promised to stick with what they do well, which is make small business loans and not dip into equity type investments. And so that, I think, helps any concerns that we have about that bill. Brent mentioned House Bill 2 and maybe another $40 million, assuming it doesn't get line item, would flow into the tobacco fund. This is good news from our opinion. On the back side of the page, House Joint Resolution 1, this was the 1% bill, 1% out of the land grant fund, which again passed the House, died in the Senate. The governor did support an alternative bill that would take half of 1% and out of just the school permanent fund and dedicate that to early childhood issues. Governor had some, I think, healthy conversations, did get to present in both Senate Education and Senate Finance. And so I imagine we'll be hearing lots more about this concept during the interim.
I imagine you will.
Two other bills that we were watching that both would impact money flowing out of the funds. House Bill 289, which would have dedicated or required the council to make 1% of the severance tax fund to invest those dollars in renewable energy projects, and it's a wide array of those. That made it through the House, but it did not make it through the Senate. Ran out of time, but I imagine we'll see that again next year. And one that we've seen for many years, Senate Bill 30, that is 1/4 of 1% of the severance tax fund, so about $12 million to fund startups that are in labs and research universities. That bill did not pick up a lot of momentum this year, but it's been around about a decade. We'll see if eventually it will make it across the finish line. I'm open to questions on any other issues listed here and otherwise.
Yes, Peter.
Did that,
I'm sorry.
I'm sorry.
Scott, my fault.
That rural library piece of legislation, my machine died, so I can't look it up. Did it have a distribution percentage that was established?
So there's a formula that and it's kind of a new formula, and Brent helped put together some of it seems to be a little volatile. I think the intent is to protect the corpus, but that is something we're going to have to look at. It's fairly complex. But really, if they only have $1 million, it's not going to be very much.
Scott, to your point, I think for the first 5 years, there were some limitations as it related to income, which will allow it to grow a little bit. The next 5 years, it's pretty much a 5-year average, much like we do for the land grant and the severance tax. It's a great idea. It's a great thing to establish.
It started out, Scott, as a $50 million request for approximately 50 rural libraries, and it ended up at $1 million.
I mean, I know the state does a great job funding, and And I think it's low, it may be part of these rural libraries as well, but we receive annual funding for the library on our campus. I know the other colleges and universities do as well. So kudos to the state. Coming out of Michigan, that type of funding did not exist up there. It's a great idea.
So assuming this gets signed, that's a sixth permanent fund that we're gonna have, so there's two additional ones.
All right, Senator, you have a question?
Yeah, actually, sorry. On the same bill though, my concern, of course, is mechanically after we give them the money, because in the past, the legislature has bonded money for libraries. And the challenge always is that the shelf life of the book is 5 years. So when you take a bond that's longer than the life of the asset, so I just wondered what the mechanism was. Is this strictly gonna be, they're gonna get cash and not be able to bond off it? Or are they gonna be bonding off what we give them?
So my understanding is it's basically a funding mechanism that would help supplement whatever appropriations the legislature makes. This would be an endowment fund, so the endowment model would deliver money to them every year that would be spread out among the many rural libraries.
And hopefully they won't bond it, correct?
Correct, and then before Linda, we had Peter.
No, I didn't.
You didn't, all right, Linda.
Well, I've had the other funds, do we have a client that's identifiable?
On the rural library fund, we're going to do our best to identify one. But it may come down to talking to whatever legislative committee oversees this. And so that may be our first place to start. But yes, we're gonna have that same problem as to how to manage the money.
And I may suggest with the funding that comes through for the universities, a portion of that Eastern acts as a fiscal agent. So if the funds are small, rather than giving everybody a check for $1,000, you may think about establishing one rural library and have them be set up as a sort of a fiscal agent. Might simplify the process.
Senator?
Governor, Senator Ross, I would just challenge you to go to the library and see how many books are wore out after 5 years. There's not many.
There may be two separate issues, whether the information is still relevant, whether or not people are actually hands-on those books. So it might be two issues, although be happy to quote the Dalai Lama, who says that if you want true enlightenment, you have to touch the actual page of a written word. And so a relationship with books is a good thing, and maybe this is a mechanism by which New Mexico can be both enchanted and enlightened. Do you? I thought you might. Before we digress any further, are there any other questions or comments about the legislative update? All right, Charlie, thank you very much. And now we've got the New Mexico private equity, which we have to have more conversations about, make sure that we're engaging in all these New Mexico opportunities productively. Gentlemen, good to see you.
So, Pavilion has been on board for a whole month, so we're trying.
Better be a good report.
This presentation was put together to address some requests and some questions by the governor, the vice chair, Councilman Austin, the land commissioner. I apologize for missing, but there were a lot of questions. So I'll just turn it over to Alan and Richard.
So we'll be quick on this. Really, what the presentation summarizes is just investment activity in the state, current state of the program, some best practice ideas that we've seen from other folks trying to do the same thing. And then most importantly, we want your feedback. You all have views and we want to take those in and figure out what is the best way to move the program forward from here. So Richard will hit a few of the slides in here that we think address some of the questions that were raised, and happy to take questions, but again, we do want feedback on ideas and concerns or anything we've seen.
And the feedback doesn't have to be today. I mean, feel free to reach out to us in between meetings as ideas come, because this is the SIC's program, and we want to build a good program for the SIC. So starting with, one of the things we did was just kind of understand the environment in New Mexico. So we looked back at New Mexico historic venture capital investment. One of the best sources out there is PwC CV Insights. They collect venture capital data and report it. Usually when you see a news article that talks about venture capital investment activity, they're quoting this data. It's not perfect because not all information from venture capital deals is publicly available, but they do the best they can with what's out there. And this graph here shows kind of the dollar amounts that they report by year going back to 1999. And then we also have the overall U.S. venture capital investment activity. So we did what's the New Mexico activity as a percentage of overall U.S. venture capital investment activity.
Intelligent page 370.
Thanks. And so you can see it really peaks, the activities peaks in 2007 on both kind of a percentage of U.S. venture capital and also a dollar amount basis. And then over the last few years, as venture capital investments have increased in the U.S., it's kind of stayed steady as a percentage of U.S. VC in New Mexico. So to dig in more on that, on the next page, on page 5, we looked at some of the databases to learn more about the investment activity. Many of the repeat investors in New Mexico are based in New Mexico or are regional funds. So it makes sense. I think one of the takeaways from that is that an important component of the New Mexico program is in-state and regional focus on funds, because these are funds that are in Mexico and have invested in New Mexico in the past. And looking at the firms that have invested, some of those are already in the New Mexico program as well. We also have companies that are receiving venture capital investments. I think one of the key takeaways from that is you look at the industries, there's really a wide variety of industries there. It's not just technology, it's not just biotech. There's a lot of different industries that are receiving venture capital in New Mexico. And then we went beyond venture capital too and looked at later stage, growth equity, buyout, what kind of activity is happening in New Mexico there. One of the examples that we kind of thought of this was when we were talking to TA, which we presented last month. We talked about their sourcing process and how they have a large database of companies. They actually have over 1,000 New Mexico companies in their database, and they call or visit multiple New Mexico companies each year. And so, even though they're larger, they're at a later stage, they're still looking at New Mexico investments. And there is a lot of investment activity in New Mexico by growth equity and buyout managers. And what's interesting is you look at the list, some of them are actually in the national program, Hellman and Friedman, for example, which was approved last year. So in looking at this, kind of got two key takeaways that we thought of. One is the potential for the New Mexico program to focus on later stage growth equity buyout type investments as well. I mean, not only are you getting that benefit of potential new investments in New Mexico businesses, but it also diversifies that New Mexico portfolio from that venture capital risk. Although venture capital is still very much going to be a part of the New Mexico program, that is a very risky asset class as far as returns go with the high loss ratios. The second takeaway was, I think we've been underutilizing the national program for New Mexico connections. A lot of these managers visit New Mexico for these meetings. They visit the state investment office to give updates on how they're doing on the fund. I think we need to do a better job of connecting the national program managers with key people in the industries here in New Mexico and try to introduce companies to them. And hopefully that will lead to some economic development activity. And then that way you're already investing the capital. You're not having to invest additional capital to generate New Mexico investment activity. The next slide lists the statute requirements, and I don't want to read each one in detail, but basically the high-level thing that we got from reading the statute is there is a focus on high-quality funds. You want funds that are institutional that can raise capital from other sources besides yourself. You also want to focus across the business cycle, startup expansion, recapitalization, things like that. And that's similar to what we've seen with other state programs as well. There's also a requirement to it's the second from the bottom bullet point, to have a manager commit to invest at least the amount equal to the amount that the State Investment Council commits to the fund. And that could come through syndicate dollars or some other form. So if you commit $10 million to a fund, the requirement is that they commit that they'll get 10 million back into New Mexico through some type of investment.
Yeah, the third bullet, though, I don't understand. What does that mean? They have one manager in the world, or? What does that mean?
One full-time manager with at least 3 years of professional experience. So it's
I know that, I read that, what does that mean?
it's basically
here, right?
Well, that requirement is no longer exists.
no, it's not located in New
So
Mexico.
what does it mean?
It's to prevent somebody from. So for example, me, if I were to go out and start a fund and say, okay, now give me funds, I'm going to invest in New Mexico. Well, I don't have 3 years of investment experience for venture capital, so I wouldn't meet that requirement. That's my interpretation.
Yeah, it's strange.
So we've already ruled out Richard.
Yeah.
But that's, I mean, to be honest, though, that's sometimes what happens with state programs like this, when you do have a pool.
We did see that in Utah when there was talk of a second fund and it was gonna be very, very sizable. There was a number of people that approached us and said, I'm gonna be starting my own group.
I love it.
And they had no experience, but they're quite happy to take
People from universities.
Okay, thank you.
The next one really is kind of meant to be a high-level overview of the New Mexico private equity program and looking at approaches. This goes back to 1993, which is when the New Mexico program started. There's really been three main approaches taken to get economic activity going in New Mexico. One is fund investments, which is what we talk about a lot here. The second is a co-investment fund, where that's managed by some town, which will invest directly into companies that are based in New Mexico. And then the third is a catalyst fund, which is relatively recent, that will target more early emerging type funds. And that's also managed by Sun Mountain.
And I think one thing that's important to note on this page is this is the all-in performance of everything. And so this doesn't reflect different advisors, different strategies, different approaches, different legislative changes over time. This really is just, here's everything you've done in the New Mexico program.
And one thing looking at it, and we don't have perfect data because we don't have data going back to 1993, so it's not perfect, but you did get unique investments from both fund investments and co-investment funds. There was some overlap, but there was also unique investments from both. And when you think of other states, some states use one or both of the approaches. So Utah focuses on the fund investments. They don't really do co-investments. I know the state of Colorado has a co-investment fund as part of the public pension called the Mile High Fund. But they really haven't had much of a fund fund. I know they've tried. So it kind of varies on what the different funds do. And then the next page was a specific question that we got from the council last time on loss ratios and comparing the New Mexico co-investment fund loss ratio to other venture capital funds. There's no one source out there that talks about what's the overall loss ratio of venture capital, and it varies a lot by strategy. So later term venture capital funds should have a lower loss ratio than a more early stage, which takes more risk. So what we did here was we calculated the co-investment loss ratio. And real quick, the loss ratio only takes into account losses. It doesn't take into account gains. So it's how much have you lost divided by the cost basis. And then we also did the number of investments here, which is just simply how many investments did they lose money on divided by the total. And then we compared that to 5 venture capital funds that we've done recent due diligence work on that we have the detail. And then we also compared it to an average of buyout and growth funds. And not surprisingly, buyout and growth funds are a lot lower than venture capital. This is something to consider with venture capital strategies, though. Loss ratios tend to be high. But sometimes it's hard to make decisions alone on loss ratio because sometimes the fund that has the highest loss ratio might actually have the better performance because they're getting paid for the bets that they're taking. So with that, we were going to talk about some of the characteristics of economic development programs that we've observed in some of our work and then also what we've read about in academic studies.
So I'll go through these fairly quickly. Some are obvious and maybe some less so, but the first bullet is really you have to focus on the long term and focus on building a sustainable ecosystem. This is not something you can change overnight. You can't just pump in money into a bunch of small companies and expect them to all grow and succeed and spin out. What we've seen successful approaches we've seen target all different aspects of it. So building out that ecosystem, which includes the law firms and the accounting firms, and the other professional service firms that are around that. And so having small companies and having large companies and having diverse industries. As Richard noted before, and this is part of that, is focusing on all types of investments and sectors. And you really have to look at the strengths of what you have as a state. So there's a lot of energy here, for example. There's things that come off of that, like energy technology or infrastructure, or some of the things around manufacturing and building new technology for pipes and things like that. So there's things that you want to build on, and you can't try and pound a square peg into a round hole. So, it's tough to build the biotech infrastructure that San Diego has, or Boston. But there's other things that you do well here that we should try and build on. Richard mentioned this also, but one of the things we found works is getting other investors to look at the state in addition to focusing on those people that are already here. So not abandoning one or the other, but doing both. So having folks like TA, we lean on them to spend more time here and help facilitate meetings for them. Or people like NGP who already spend a lot of time here. Just working with those managers to help build their network so that they've got more of a connection here. Because what we've seen also is that it's a lot easier to take a company from 100 employees to 150 than it is from 0 to 50. And the returns from that can be significant.
The other thing we've seen in Utah is some of the outside firms have international connections, so they've been able to help take some of the local companies international, which has benefited both the in-state firms and the out-of-state firms.
Yeah, so one approach has been taking a mid-sized company and making it more regional. So expanding it across the Southwest, or expanding it across the U.S., or expanding it internationally. And you can get a lot of job growth and a lot of economic development from that type of thing. Working with the government and community organizations, I think making sure we're plugged in, helping facilitate meetings, and trying to piggyback on conferences and other things. I know Richard's participated in a few, and trying to really create some connections around that. And then really just the diversification. I mean, this is something that we've seen a big benefit of, and it's kind of runs through all of these, is making sure you're looking at different stages of company, different industries, because not everything fires on the same cycle. And there are industries that get very well connected, like real estate. You don't only want to be in sort of builders, mortgage finance, and other things, because when that cycle turns, everything turns with it. And so making sure you're diversified, but doing it in a way that's smart, not trying to diversify into something that's just not there. So that's a balance. And really, what we want to do is help create an environment where companies are getting funded and they're growing here, and they're not just getting started here and then pulled over to Silicon Valley or to Austin or to somewhere else. And that happens a lot. It happens in Utah, but the ecosystem has been built, and Silicon Valley is a giant sucking force of talent. Because they tell the companies all the talent's here, if you want to scale, you got to be here. And so it's really building it so that you're not just funding companies and having them move, you're funding them and having them grow here because the environment is suitable. And then we've got another slide in here that just has some points from some academic research that are things just to keep in mind. I think the biggest thing is making sure that whatever we're doing in the program isn't crowding out private investment. We're attracting the right people, but we're making sure there's a balance. We're making sure these are commercially feasible investments and sustainable. And so while we can use the SIC money to help provide a catalyst, you certainly don't want to become the only source of funding. You want people to be commercial. You want them competing. And frankly, there's some things that maybe shouldn't get funded if they can't attract others. But really it's trying to make sure there's a balance and there's education, and we're utilizing all the resources available in the state. And so, as we said at the beginning, that's kind of our take a month in, and just also, we've had the benefit of being around the SIC for some time and appreciate the relationship. And this is not something that's easy to do, so we're happy to take any and all feedback, and whether that's today or if you want to funnel it through David and his team. This is going to be a long-term process, so I think things definitely won't change immediately overnight. You've built a lot, you've done a lot already, and I think we just want to try and build on that.
Okay, great. So I'm gonna ask the commissioner, then I'll go to Harold.
Thank you, Madam Chair. So I appreciate the presentation. I very much appreciate the fact that Pavilion has come on board for the Mexico Equity Program, just given your track record. I think with the Utah program, if I'm not mistaken. And so, I'll just preface my remarks by saying I believe the State Investment Council actually does have a role to play in building New Mexico companies. I do. I don't know what that role is. I mean, obviously, we've had people who propose, like, let's take the whole 24 billion and put it back into ourselves, which, God bless them, but that may not be the prudent thing to do. So, Madam Chair, I'm preparing to make a recommendation for this council and for you to consider. I apologize that I didn't give you a heads up, but it sort of just came to me right now. So on this last page about providing feedback to Pavilion and our staff, I'm wondering if this council would consider like a working group, like a subcommittee of members of this council to just kind of take a look at how we want to grow our climate and environment here in New Mexico to be more friendly to investment in our New Mexico companies. And it can include some of the things that were mentioned. I appreciate like exposure to the national program, more emphasis on the later term investments, not the earlier stage investments. I heard an anecdotal story, maybe you can verify or not, that there were actually economic development folks in Utah that would approach people on the ski slopes of Utah to recruit them to come and be serial investors, like serial entrepreneurs in Utah, because they had like a track record of like building companies and turning them around. And we've got ski slopes here. That's my recommendation for.
I'm happy to go to the ski slopes and be the #1 recruiter.
Excellent.
So there you are. I'm gonna hold your suggestion until we get other comments, but I appreciate that. Anything else that you've got, Commissioner, before I move? All right, Harold.
I think it would be really helpful if we took a look, at least for me, if you go to page 8, I mentioned this to you guys before we started, which is the chart down at the bottom. I'd just like to see more information in that. I realize this is just the start, and you indicated this is high level. We have a lot of things coming down the road, and we're gonna hear a lot more from you in a month. I'd really like to see that broken down to the current managers, what the current manager's done since the current manager came on board, what happened before, and kind of what led to those numbers. If you could do that, that'd be really helpful for me. And that's just to be really like to see that.
Staff to get the data to do that.
Okay, thank you. Just a second, Peter. Senator, did you have something or did I? Okay, Peter, it's to you.
No, only in terms of establishing a fact base, which I think is where you're starting here, there's a lot of discussion, and the governor is very vocal about, are we doing enough locally, which is, of course, what the commission also mentioned. We probably need a fact base. I don't know what the answer is, but I don't think we have a good sense of how much we are, in fact, actually doing. When you look through the entirety of all of our programs and all of our investments, my sense is there is a substantial amount that is going into New Mexico in a variety of ways, but maybe I'm wrong, I don't know. And before we start saying we should do double, triple, or put 24 billion, we ought to know what we're actually doing currently, and so that we have a factual basis for making those decisions. And I didn't see that particularly in this initial set of numbers.
It's a good idea. We can certainly go through the national program and identify the investment, because I think you're shortchanging yourselves if you don't highlight that, because you're indirectly supporting New Mexico by doing that too.
That's my point. I don't care what the program is.
Right.
We've got SBIC, now $100 million investing in New Mexico. We've got Catalyst, now $20 million. We've got Sun Mountain with 300, I don't know the numbers, but yeah. And our New Mexico program, our national program, we need to know what it is before we start saying it's sufficient or insufficient.
And I might just, which is a little unfair, but I think you get to be a little more unfair when you're the chair.
Yes.
And comparing apples to apples, because you're a global market set of strategies, and what you get for that in terms of return to some degree is different than the return that we're looking for in building an ecosystem. And as part of that information, I'm also was intrigued and very interested as a follow-up in a month that second level of investments, if they're growing and you're creating an ecosystem, it seems to me like we might be a bit stagnant on that secondary investment set of strategies, and that can make all the difference in whether or not our investments are giving us everything we desire in that return. It's not just that first set, and that's not, I mean, I wanna close those gaps and make sure that we're doing that productively and want more information there, and wanna make sure that we're not stagnant. All right, yes, Scott.
I think to me, this is probably gonna be, or probably is the most important discussion this board's gonna have over 2019-2020. I don't think anybody's gonna argue that economic development fundamentally has to be done to help the state moving forward. I'm happy to hear that we need to look at more than just venture capital. That's the perfect statement. It's so risky, we have to look at all of them. I'm also happy that you talk about using national private equity firms. I've always been concerned that if somebody develops some sort of a business idea in New Mexico and a national private equity won't touch that thing with a 10-foot pole because their analysis just says this thing's not gonna work. And yet, theoretically, in my analogy, we bring that into New Mexico and we'll have somebody in New Mexico look at it and then we invest in it. That's not gonna work moving forward in the global scheme. These investments have to make sense, they have to be analyzed and provide a metric. The one thing that to my eyes, that I think is missing here is an exit strategy. That first firm that came through today, I guess it was Advent, mentioned that they stick to their exit strategy and they have an exit strategy developed on the front end. We don't seem to do that. I think that that's important. If we have an investment, assuming you can get out of it, and we can have an investment, say $10 million, and we can exit and make $50 million, we ought to do that instead of waiting for something else. I mean, I can remember that blood testing group, Theranos, if I'm pronouncing that right.
We didn't have money for that.
But if you did it early on, you were looking to increase your earnings, you went to zero, right? So I guess like a bird in the hand versus two in the bush type theory. But the other side too is we see investments that we make these seed investments in, and that money goes to zero. Then we invest again, and that goes to zero, and then we make a third one. That doesn't make any sense either. I think at some point in time, you have to realize that that particular investment didn't work and move on. It's a key thing that we need to figure out here, the strategy.
Thank you, Scott. Harold.
I'd just like to also add that, that's kind of the, I don't know whether it's the monster in the, above the room or what in the corner, but by law, we can invest up to 9% of the severance tax fund in private and differential rate investments. And I think that some on the council have not liked to talk about that, and this isn't meant to be critical, because I understand the arguments, but I'd like you to include that kind of note, an analysis of that particular aspect, and because there's you can argue about it, $100 million worth of funds that are available there by statute, if in fact the 6 members of the council chose to do it. So I think we ought to take a look at that and incorporate that into your analysis to see it, and because it's not like we have to reach up the pie in the sky to find more money, if in fact it could be effectively used. I think it's important that become part of our conversation, just because we can't, it's there, it's in the law.
Linda.
Actually, we have touched upon that. And this was Sun Mountain Capital did an analysis, and the conclusion was that we did not have capacity in New Mexico to deploy that amount of money with a profit motive, that we don't have sufficient number of companies that are going to merit our investment, knowing that we need to get a return out of these. That 9% is too much for what is currently available in New Mexico. So that's probably something that you will look at as you look to see how to develop this, is what companies are out there that have the capacity to meet the expectations of investors, including us.
Linda, let me just elaborate. I think I totally agree. It's possible we're already at 9%. I'm just throwing numbers around here. We don't know it.
Oh, because we're national.
When you look through what we're actually doing, that's why we need that fact base before we start arguing about what the right number is or isn't.
Senator Jennings.
One of the greatest investments we might be able to do is to invest in a natural gas pipeline. Get our gas out of northwestern New Mexico. And get it to Mexico, or get it to going east instead of going west to California. And even by time that gas comes down, pipelines in there full when it gets into our state and gets you San Juan, there's no room for it. And so you have, basically have stranded assets that could be a great benefit to New Mexico and also relieve the unemployment, some of the unemployment you have up in the northwest quarter.
Linda. Although that's very appealing, we do not make direct investments. We do not have the capacity of the state investment office to analyze those things, to purchase them and to manage them. So were we to find a company that could do that, we might promote that company to one of our funds, but we do not do direct investing.
Anyone else? Let me recap. I mean, this is clearly an area that lots of folks have conversations. I'm not so sure that that's exactly what Senator Jennings meant. Maybe it was. But thinking through where we are, what our infrastructure opportunities look like, how we get there. And some of the information, we're just in the beginning stages of having our New Mexico private equity professionally managed. And that changes the opportunities, I think, and the discussions as a result. And certainly, I think, gives us greater, which is what we want, protections about the investments that we make. And I might actually disagree with you about capacity because it depends on how we determine capacity, how we're outreaching, to your point about other companies that we don't do those secondary investments, that's what I'm calling them, so that these companies move. So it really depends on what information we're looking at, how we're valuing that information, what our short and long-term strategies are, and then deciding what we do about it. So I'm very interested actually in the commissioner's idea about an additional committee, but I don't know what, depending upon the will of the investment council, whether that should be a subcommittee of the investment committee or a standalone committee. But I do think this is an area, every aspect of it, total authority based on up to the 9%, what we're doing about developing an ecosystem, what we're doing about closing the gap between those first, the initial investments in private equity, once those companies are ready for second and third phases of their corporate or economic development. Those are things that we ought to be talking about, and we now have an opportunity to do that more robustly and in a more informed manner so that I can do this with some impunity, so that it's not political. Like these sound great, are they great? And now I'd love to see this council do that next phase, which is, are they meaningful? Steve, did you have something you wanted to add before I go to a question for Harold?
Just a comment, would it be wise to involve the Economic Development Department in what we're
Absolutely not.
discussing here?
We should have every available asset, including the assets that we have in the state government. And given that we're asking the New Mexico Economic Development Department to think about a whole host of strategies, we should absolutely do that. And I think it's a good comment and suggestion.
Just the last thing, Governor, I just happen to really agree with you about the fact that it's not a settled point that there are no possible investments. I'm hearing on a consistent basis that there are lots of investments that there's no funding for by our manager and others. And I think that's again, I hope you guys will take a good look at that because let's verify, let's make sure.
Or how we determine what kind of investment it is so that we don't do that the next set, right?
You guys can really help, this could be really helpful.
So let me do this. Are there any more basic comments, questions? How do folks feel? Do we want to make that an action item and decide today? I'm happy to do that. Or would you prefer to put it, Linda would prefer to put that on the next State Investment Council meeting. Any objection to that, Commissioner? All right, so then I'm going to do that. I'm going to put that, what I would like, Linda, from you between now and then is some information about how that would look, given that we have an investment committee. So should it be a subcommittee, a standalone committee? My preference actually in this regard is a standalone committee, but I would like more information. I don't care how you get that to me, so that we get it on the agenda in a productive way and we have a good discussion about it. All right, having Oh, Harold's ready. You know, usually you're ready for the second, but he's ready now, having no more, on our, closing matters. We have a public comment period, so I know that you're excited, but I'm not. I'm excited to hear, I'm teasing Harold, to have that public comment. Do we have public comment? We do, yes, sir.
Well, I'm glad this conversation is being held. I think one of the things that, Governor
Give us your name, I know
Kenneth
you do.
Segurano, is that right now states are in an active competition for opportunity funds. There's $2.9 trillion in the pot out there. And I just got back from San Francisco from the conference. Every state there had multiple state representatives there trying to figure out how to attract that 2.9 million, part of the 2.9 million. Tax capital invested with motivation. The investors are people who have capital gains, you get deferred tax, you get no taxes. One that we've identified multiple projects, companies that could use investment. One of the biggest problems we're starting to find, Governor, is that the way the opportunity zones were chosen, some of the areas that are most effective that have companies are not in an opportunity zone. There's opportunities there, San Miguel County, Santa Rosa. Right now, Santa Rosa, they're building a nice hemp factory there, not factory, but where they grow the buds. They sell the buds and they just build warehouses. They were able, because the gentleman worked for GE, he was able to go to GE commercial, and they really well. But in spending some time with the SIC-2019, there's a lot of farmers who are just very excited about that, the whole opportunity. We've had a conversation with a group out of Colorado who's looking possibly to invest $191 million in a research commercialization facility in Los Lunas. We've identified property for them. Los Lunas needs 2,000 houses. Before Facebook moved in, there were 2,000 houses short. They need 2,000. We're looking at one company that builds homes from shipping containers. I'm investing in that. We're moving it from Gallup to Albuquerque because Los Lunas has that opportunity. So there's a lot of opportunities for investment. And either New Mexico invests or they help find investors. And I don't see that happening from New Mexico. The other one is, we've invested in the film industry. I think there's some facilities that can be built in opportunities. I was in Los Angeles with multiple studio people talking about opportunity zones, and everybody goes, you realize that Albuquerque Studios is an opportunity zone. You could set up an opportunity zone plan there to produce movies. So there's, I brought I'm going to beat this drum to somebody here, but I think that looking at opportunities and with the leverage that this council has as far as money to invest, and you can leverage a lot of those people that want to invest, and then the guidance of somehow identifying and other opportunity funds. There's one other fund. There's also one fund that's not going to be popular. Several years ago, there was a legislative wise. It was created an opportunity that the State Investment Council could invest and create loans for films. And for various reasons, not that I want to get into them, but I think that opportunity is there, and I don't know what happened to those funds, but I know that if they want to use it, go into other use. But I think we should look at, the council should look at reenacting that program in providing loans to filmmakers to and focus on creating a New Mexico-based industry, not an LA-based visit, a circus comes to town industry. And Governor, you've shown commitment to it. Although this new bill, I'm not a big fan of it, because somehow Las Vegas got left out of the 60-mile radius to get that extra 5%, but, that's happens. But, that's what I have to say, and I'm gonna be strong. And my marching band is ready to go.
I appreciate, as I said last time, that you come to these meetings and participate, and I'm actually gonna, if you'll stay after the meeting, I wanna make sure I connect you up to, our economic development department and how they're strategizing for 5%, which is what you're talking about, the rural investment strategy, and increasing the credit if you're doing, producing films in rural areas, but also what their work to get at developing, I'm using this word too often, a New Mexico film ecosystem. It's not just about other companies coming in, and that's why there's also a 10-year component that really strategize getting people to invest and stay in New Mexico, and then by that effort, creating more opportunities for New Mexico businesses. So hang in, I'm gonna make sure that we connect you, and I realize that that's not in replacement of continuing to talk to us about our investment strategies. And I appreciate that, but I want to add that in addition to.
And I'm glad that you're streaming. I brought my streaming equipment in case there's.
Good, I need you as a backup. That's good, that's a good plan. Thank you very much for doing that. Anybody? No, so anybody have any other questions or comments? Yes, sir.
Yes, thank you, Madam Chairman, and thank you, councilors. Encouraged by this conversation around the table and the commissioner's idea of a subcommittee. To that note, I think it's more of a strategic investment fund than one that could forego actual real returns. But because it is a local thing to maybe trap assets that the senator mentioned, to look at all of those holistic things to make the ecosystem more profitable for the state as a whole will, just like the film investment, it is not true investments, it's returns that build the economy. So thank you very much.
Thank you. All right, any other public comments? All right, seeing none. Harold, your motion may now be in order.
I move we adjourn.
We have a motion to adjourn. Do I have a second?
Second, I can't second. I'll second.
Linda, I need a second. All those in favor say aye. Aye.
Thank you.
Any opposed? Any abstained? We are now adjourned. Now we've got Senator, you write the second,